My system had a problem. Good afternoon, everyone. It is my great pleasure to welcome you onto this free online training on applying the IFRS sustainability disclosure standards. Co-hosted by the UN Sustainable Stock Exchanges Initiative, the IFRS Foundation, the World Bank's IFC, the Lao Securities Exchange, and the Lao Chamber of Professional Accountants and Auditors. We are excited to have approximately 200 registered participants joining us. Today, 5th June 2025, as we celebrate World Environment Day, we gather with a shared mission to advance transparent, accountable, and sustainable financial markets to high-quality sustainability reporting. Sustainability is no longer an optional consideration. It is a strategic, iterative. The IFRS Sustainability Disclosure Standards, developed by the International Sustainability Standard Board, ISSB, provide a globally consistent framework for discussing sustainability-related risks and opportunities. These standards empower investors, regulators, and stakeholders with the information they need to make informed decisions in an increasingly complex world. Whether you are a professional, sustainability practitioner, auditor, or business leader, master these standards will equip you to enhance transparency in corporate reporting, align with global best practices, and drive long-term value creation by integrating sustainability into financial decision-making. Over the course of the session, our experts, facilitators will guide you through key concepts and structure of the IFRS Sustainability Disclosure Standards, practical steps for implementation, and the real-world example to illustrate their application. This is also an opportunity to ask questions, share insights, and network with peers who are equally passionate about advancing sustainability in financial reporting. As we begin, I encourage you to engage actively, think critically, and consider how these standards can be applied within your organizations. The transition to sustainable business practices is not just a compliance exercise. It's a transformational journey towards a more sustainable and inclusive economy. Before we proceed, we would like to extend my deepest gratitude to our speakers, partners, and participants for making this training possible. Your commitment to learning and applying these standards is evidence of the collective effort needed to build a better financial ecosystem. Let's make today's session interactive insightful, and impactful. Thank you, and let's begin.
Many thanks, Mr. Thirakul, for opening the session for us there, and I think some excellent advice for all of the participants in framing today's conversation. So many thanks for your kind opening of the session. And hello and welcome everyone from my side. I'm Fiona Quinlan-Wells from the UN SSE team, and it's a real pleasure to be here with you today in the training session. So I'm just going to give a brief opening introduction to the session. Now we've had those overview remarks. So firstly, just to reiterate the thanks already shared by LSX to all of you for being here with us today as participants to join us in this session. We greatly appreciate it. This programme that you're taking part in today is a truly collaborative effort, really driven by that demand we've seen in the market for more support to implement the IFRS sustainability disclosure standards. You're among, I think, now over 15,000 individuals who've taken part in this programme across the world. So in very good company, we hope. And we'd also like to say our thanks at the start of this session to the IFRS Foundation, our co-facilitators of the training, and to the IFC, our partners on this programme. And of course, a final thank you to the Lao Stock Exchange and the Lao Chamber of Professional Accountants and Auditors for hosting us in today's session, which is fantastic to see so many of you who've signed up in your market as well. Great. So I'll cover off a few housekeeping points now. So firstly, you'll probably have realised by now that all participants are on mute. However, we would really still like to encourage your participation, as our colleague from the LSX has already highlighted. So please do make sure to use the chat function if you'd like to share any comments or reflections as we move through the training. And also, please make sure to make use of the Q&A box that you'll see on the bottom tab within Zoom to ask any questions that you might have for the team. So there's a great opportunity throughout the training to ask any questions that you might have about the content we're covering or the implementation of the standards. So please don't be shy and ask all of your questions. We have 4 of us here facilitating the training today. So whilst we're not speaking, we're very happy to answer those questions for you. So as you probably know, we have 3.5 hours of live training here today together. We also have an optional homework assignment that you can take away to do afterwards if you'd prefer to or like to continue your learning. As I've already highlighted, there'll be lots of opportunity to get your questions answered throughout, so please do ask those as we go along in the Q&A box. We do very much encourage your participation and interaction in the training session. So throughout the training, there is several opportunities to interact. We use Menti and polls, so we'll introduce those when we get to those parts of the session. And also, you will receive a completion certificate for taking part in the training. So to receive your certificate, you'll need to fill out the survey, which we're going to share with you at the end of the training. So stay tuned to hear more about that later. So to introduce who's going to be delivering the training for you today. So as I said, I'm Fiona from the SSE team. I manage our training academy, and I'm joined by my colleague, Lois Guthrie, who is our senior specialist. Hi, Lois. And then, as I said, alongside us, we're very fortunate to be joined by our colleagues from the IFRS Foundation Sustainability Capacity Building team. We have both Robert and Bella joining us today, Robert in Frankfurt and Bella in Beijing. And so just to cover off a little bit of an overview of what we're aiming to achieve today. So we have 3 key learning objectives from today's training. Firstly, we'd like to help you to understand the ISSB standards. Secondly, to understand how to use the ISSB standards and put them into practice. And finally, we'd like to help you identify the steps that you can take to develop your first disclosure plan to apply the standards. So we break those learning objectives down into a number of modules to really take the approach step by step and simplify it. So you'll see in this wheel here that we have 4 key areas we're going to work through. So we'll start with prepare, which is all around building on existing knowledge you may have of sustainability reporting, understanding its purpose, the global reporting landscape, and how we've developed the baseline of the IFRS S1 and S2 standards. Secondly, we have Align, which is all around setting direction for your reporting. So thinking about how you can apply and use the standards and what additional disclosures you might need to add to your reporting to align and meet regulatory requirements. Then we move into Implement, which is all around your practices and systems. So thinking about how you can identify, evaluate, and integrate sustainability risks and opportunities within your organization. And then we'll finish with our final module, Communicate. This is all around the final format for your external reporting. So thinking about the location and timing, how to do so efficiently and with confidence. So just another way of showing that to you, we here have the agenda for the session, which shows how the content for the modules breaks down. So you'll see that we have a short break that we take in the middle of the session, which we know is quite necessary for 3.5 hours of training. And we also have some follow-up options at the end in terms of homework and resources. But just to note, our module 2 on Align is really where a lot of the content is. So don't worry, when we finish module 2, we're well more than halfway through the session. And just to say a little bit about the training materials that you have access to. So I think Lois has already shared it with you, and I think she'll probably post again just now, a link to the event web page where you signed up for this session. And on that page, at the bottom of the page, you'll find a resources section. There you can find the slide handout, which covers the training slides that we're talking through today. And that includes hyperlinks to all of the resources that we'll discuss as well. So we'll share some links in the chat as we go, but please make sure to look at the slide handout on the website if you want to find the links to any of those resources again. Also, the optional homework assignment is available in the resources section of that page as well. So there you'll be able to download that exercise as well. And so to mention the homework exercise briefly, the focus of this is about developing a draft disclosure plan for your organization. So helping you to put into practice what you've learned on today's training program. It isn't mandatory to complete the homework. We're not at school, but it's also something we do encourage for you to help your own learning and to share with your colleagues and help to drive your conversations internally. So there's no need to submit this assignment to us, but if you'd like to take a look at it, you can find it at the bottom of the page at the link that Lois has just shared with you there in the chat. Okay, so just to mention a few key resources as well that we have from the SSE. So we've really developed a toolkit to help you go into more detail on some of the areas we've talked through in the training today. So we have several resources that Lois has linked to there that can help you to implement the ISSB standards and also consider some of the climate-specific requirements relating to transition planning and climate metrics. Okay, so that's just a bit of an overview of what we're going to cover. But to get us started, we'd now like to go to you for a bit of an interactive exercise. So we're going to be doing our first Menti exercise together. So you will receive the link to access the Menti very shortly in the chat. And if you follow that link, it will take you through to the question that we have for you to answer. So I think that link should just be coming, but in the meantime, I will share my screen to show you Menti because that shows you some more ways that you can join us there as well. Let me find that link for you 1 second there. There we go. Sorry, thank you, Lois. So if you join through that link that Lois has just shared, that will take you to Menti, to the questions that we have there. And our first question for you is really just to get a sense of your reasons for joining us here today. So if you want to tell us in your own words, briefly, what you've joined us for today, what's the focus that you want to get out of today's training session? A few other ways you can join Menti as well, if for any reason that link doesn't work for you, is to go to menti.com, as you see at the top of the screen, and enter that 8-digit code that you see displayed at the top of the screen. And you can also use that QR code that you have in the bottom right of the screen, sorry, left of the screen there as well, as another way to access this. We will come back to Menti a few times during the session, so it's worth making sure that you can access it now so we can use it together throughout the training. Okay, great. I can see lots of you are starting to get into the session, so that's brilliant. So we have words coming through around knowledge, best practice, inspiration, or we hope we can be inspiring, we'll try, understanding, examples, emerging trends, thinking about risks. Fantastic. I think those align well with hopefully what we aim to cover and help you with in today's training. So great. I think you're in the right place. So I'll move on now. We've got one more quick question for you, just to get us started. And this is just really to get a sense from everyone as to where you're at with your current understanding of the standards. So there's a sliding scale that you can use there to select from not very comfortable on the left-hand side. You know, maybe you're just starting to understand these topics, to feeling quite comfortable and having a good understanding already on the right-hand side. So let us know how you feel currently in these 3 different areas. And it's good just to get a sense of where everyone is at in their current knowledge. Okay, so a little bit of a mix, but it seems overall most of us are kind of lower to middle on our current comfort with understanding these topics, which of course is very understandable. That's why we're here today for the training session, so no problem at all. Great. Okay, thanks everyone for sharing that. So I'll just reshare the slide presentation now. But please do keep that Menti tab that you've opened available in the background, because we'll come back to that later in the session as well to use it again. Okay, so I'll get us started now with just taking us through the first introductory concepts in Module 1 before I involve some of my colleagues as well to share their views. So the first thing we just wanted to share with you is a quick disclaimer. And this is just to be clear about how we're using examples from companies in today's training. So these are really just here to help expand on what we're talking about. We know sometimes a real example can help to understand the topic better and put things into practice. However, examples that we're using here shouldn't be seen as the best or necessarily the right way to do this. Each company, of course, is unique, and you need to do what suits your circumstances best. However, hope we can serve as some inspiration here with the examples we provide. Okay, so with that out of the way, as I said, I'll kick us off in our first module, prepare. So this is all around building that solid foundation of knowledge and building on what we already potentially know about the voluntary standards and frameworks that exist. So in this first unit, to build a solid foundation, we generally like to cover 3 aspects. So firstly, why to disclose sustainability information and the purpose. Secondly, the landscape of guidance and disclosure frameworks that have evolved to reach the ISSB standards. And finally, giving you an overview of the global baseline, that's to say the requirements and core concepts in the IFRS S1 and S2 standards. Okay, so to get started, we'll focus on purpose to begin with. So thinking about why we report and what our drivers are for disclosure. So to get thinking about this together, our starting point is a quick poll. So we'd like to know really, what are your reasons for disclosing sustainability related information? What's driving you in particular to be focused on this topic? So this is a multiple choice poll. You can select as many of these answers as feel relevant for you. And I should say the poll should have opened on the screen for you now, but if for any reason it hasn't done, also feel free to share in the chat what your responses would be with us as well. So I'll give everyone a moment just to respond to that poll. I see the responses starting to come through, so that's great. Okay, excellent. As I said, we really do encourage participation, so encourage you to share your answers as much as possible. It's always great to see the responses. As a target, we always try to get at least half of people taking part in the polls. So I see up to about 40% of you. We're over 245 of us here together now, which is great. So I'll give you a few more seconds to get your answers in. And then I'm going to close the poll there and share those results with you. So it looks like particularly regulatory requirements is coming out for many of you as your top reason for focusing on this topic. And then perhaps your second most common response being your investors and maybe wanting to respond to those. But I see that there's a mix of you who have perhaps other motivations as well, and also a healthy number who are maybe just starting their journey in sustainability reporting, which of course is absolutely fine as well. And we hope that we can evidence today some of the external and internal reasons why it's good to focus on this topic. Okay, great. I'll stop sharing that with you there. Just to say, you might need to minimize the poll window and just close that down for yourself as well so that you can see my screen again. So we've highlighted there a number of potential drivers, but just to focus on some of the key ones that we see as well. So we've seen a real growth in investor interest and focus on sustainability and ESG in recent years. And the data we're showing you there on the screen is the number of signatories to the Principles for Responsible Investment each year. And you'll see we've reached a sort of a bit of a plateau now, but we've got a big uptick and increase in recent years in the number of investors committed to these principles. So what is it that's really driving that interest from the investor community? Well, I think what we'd like to highlight here is that a key driver behind this demand is the financial relevance and financial effects of these sustainability issues. So the data that we have here is a study of retail investors done by Morgan Stanley. And you can click on the link in the slide handout at the bottom if you'd like to see more about this. And what they found in the study is that the top driver for these investors that was driving their interest in sustainable investment was actually the financial performance. So really important to highlight, this isn't a nice to have topic or a focus just on having impact. It's really about the financial relevance of these factors. And so it's important to remember today we're talking about disclosing financially material sustainability information. And so we're going to talk later in the workshop about what we mean by material, but we wanted to be clear from the start what sorts of financial effects investors are looking to have more information on. So firstly, let's start with the effects on the company's performance, which is often seen in the statement of profit or loss, or perhaps the income or revenue and expenditure. So sustainability related risks and opportunities can have financial effects through a number of possible options. For example, they could change the revenue mix or total revenue of a company, maybe if demand for its products and services change due to sustainability issues, or if its production capacity might be disrupted, for example. But we can also see changes in expenditure as well. For example, increasing costs due to rising energy prices or needing to invest in R&D, or of course costs relating to deploying new practices in the business to manage risks. And you're also going to hear us talk today about effects on a company's financial position. So let's also look at what that means. So we often see a company's financial position on the balance sheet, also known as a statement of financial position. So for example, a company could experience changes to certain assets or liabilities. We might even see write-offs of certain assets that need to be damaged or repriced. And another possible financial effect could be changes in the cost of capital. So this could, for example, include increased insurance premiums, maybe due to increased extreme weather risk, but it could also see new access to capital through structures such as green bonds as well. And so just a few more things to highlight in this first section. So we also want to really highlight some aspects around sustainability, risks and opportunities that are really essential to our understanding. So you might have seen this diagram before, which comes from the World Economic Forum's Global Risk Report. And what we want to highlight here is that risks can really evolve over time. So as you see on the left-hand side with the 2-year shorter-term risks, these are quite different to the risks that might be most significant in 10 years from now. However, what's important for our disclosure is that we're preparing for those risks that we might expect to arrive 5 or 10 years from now. And actually, we might need to make investments or changes in our business today to either mitigate those risks or realize opportunities. So what's important is to be thinking ahead and also recognizing that the financial effects could occur in the shorter term if we need to take action now to manage a long-term risk. And another final point just to end on for this section is just to highlight how interconnected these risks are as well. So here we see another diagram from the same World Economic Forum report, which shows all the different types of potential risk and how many different connections there are between them. And so whilst we might think about the two ISSB standards as being separate, so one for climate and one for other sustainability topics, however, in practice, of course, these topics are very interconnected. And so separating out the standards into one topic or theme doesn't remove these connections. We really need to think about the whole when we're making strategic decisions. And so when we're disclosing information in accordance with the standards, it's important to remember and keep in mind how to connect between these topics as much as possible. Okay, so that was the purpose module. I'm now going to hand over to Lois for landscape.
Thank you, Fiona, and hello, everybody. Fiona's explained why the IFRS sustainability disclosure standards are necessary. Now we're going to look at how they have developed within the existing landscape of reporting standards. But before we do that, let's have a Zoom poll to find out what types of frameworks you are currently using. So you can answer as many as apply here. Are you currently reporting using CDP's questionnaires, the Global Reporting Initiative standards, the Integrated Reporting Framework, the Sustainability Accounting Standards Board's standards, the recommendations of the Task Force on Climate-Related Financial Disclosures, the principles of the United Nations Global Compact, or something else? And if it's something else, please do tell us in the chat. I'll just give you another few seconds to give your answers. Yes, quite a mix here. So let's end the poll and share the results. So it seems that most of you are using integrated reporting, followed by Sustainability Accounting Standards Board standards, and others using a mixture of other frameworks. It's very helpful for us to know what types of frameworks you're using. You've told us that there are quite a few other frameworks you're using, so please do let us know what they are in the chat, but thank you for sharing that. Let's move on now to look at the IFRS Foundation itself. So the IFRS Foundation is a not-for-profit public interest organisation established to develop high-quality, understandable, enforceable and globally accepted accounting and sustainability disclosure standards. Within the IFRS Foundation, there are two independent standard-setting boards, which you can see at the bottom of the screen. The International Accounting Standards Board, in the dark blue box, was formed in 2001 and prepares financial reporting standards, which are now in place in about 140 jurisdictions around the world. The sister standard-setting board, the International Sustainability Standards Board, was formed in 2001 following strong market demand for its establishment, and it released its first two standards, IFRS S1 and S2, which we'll be talking about today. They were released in 2023. Governance of these standard setting boards is provided by trustees, and they are in turn accountable to a monitoring board of public authorities. Being in the same organisation, the two standard setting boards work closely together to ensure that the sustainability and financial reporting standards are mutually reinforcing and complement each other. So let's look now at how these reporting standards have evolved. You might be familiar with some of the logos on the screen here, and it might look like a rather confused picture, but the main message I want you to take from this slide is it is a picture of simplification and harmonization. So many of the organizations represented by these logos here focus on meeting investor needs for sustainability information. The GRI focuses on broader stakeholder information needs. But actually, these organizations have a lot in common. They share objectives and many content elements. Some of the organizations, like the ones you see at the bottom, the Climate Disclosure Standards Board, Integrated Reporting, which many of you are using, and the Sustainability Accounting Standards Boards, their work was consolidated into the IFRS Sustainability Disclosure Standards. The TCFD, which is the Task Force on Climate-Related Financial Disclosures, has completed its work. It no longer exists as an organisation. Its work has been adopted into and is monitored by the IFRS Foundation. Similarly, the work of the Transition Plan Task Force, which we'll look at a bit later, has been adopted into the IFRS Foundation insofar as it relates to disclosure. CDP has aligned its climate questionnaire with IFRS S2 on climate disclosure, and the IFRS Foundation and the GRI are working closely together to jointly identify and align common disclosures. So as I hope that shows, this is a simplified and harmonizing landscape. Let's look at another Zoom poll now. So if you are currently using TCFD, you might know the answer to this, but even if not, have a go at answering this. The question is, companies who disclose using the Task Force on Climate-Related Financial Disclosures recommendations automatically comply with the ISSB standards. Is this true or false? What do you think? Yes, okay. Let's end the poll there and we'll share the results. So most of you said it's true. Some of you said it's false. Well done to those of you that said it's false. It is in fact false. Now, companies that already disclose using the Task Force on Climate-Related Financial Disclosures recommendations will already be a long way towards complying with the ISSB standards, but cannot assume that they conform. The reason is that there are some differences between the TCFD recommendations and the IFRS Sustainability Disclosure Standards, and we're going to look at those now. So there has been a comparison prepared. You can find the link to the comparison that's shown on the left-hand side of the screen, which shows that there's a good deal of common ground between TCFD and ISSB, but there are a few differences. First of all, there are differences in wording. So different words are used, but to capture the same type of information and with the same meaning. Secondly, S2 can require more detailed information than the TCFD. For example, might ask for more information on the use of carbon credits for satisfying GHG emission reduction targets. And thirdly, S2 provides some additional requirements and guidance, in particular sector-specific guidance, which we'll look at in a moment. So let's turn now to the objective of the ISSB. The ISSB is focused on developing standards that provide a common language that's called a global baseline for sustainability information. That global baseline enables comparable and consistent sustainability disclosures across global capital markets. And the IFRS Foundation is working with jurisdictions around the world, as well as other stakeholders, to achieve the adoption of this global baseline to set the common language for sustainability reporting. But of course, what's in the global baseline may not satisfy all the information requirements of stakeholders around the world. Therefore, the little boxes you see on top of the blue oblong, they represent building blocks to which jurisdictions, regulators, and others can add information requirements to the global baseline. Additional disclosures can be required and presented as long as the information does not obscure the disclosures required by the global baseline. So what could be a building block on top of the global baseline? Well, it could be the type of information that the GRI has in their standards for a wider stakeholder group or jurisdiction-specific information. So taking this building block approach reduces the need to duplicate information by having this globally consistent baseline, but also allowing for other requirements to be added. Just to say briefly, there's global backing for this, for the global baseline, which is represented in the standards. The International Organization of Securities Commissions have endorsed the ISSB standards and asked their members to incorporate the standards into their regulatory framework. The International Auditing and Assurance Standards Board has issued an assurance standards to support sustainability reporting. The IFRS Foundation has a regulatory implementation program to support its work with jurisdictions that are adopting the ISSB standards on a voluntary or mandatory basis. And of course, there's work to support market participants around the world who wish voluntarily to adopt the standards. So let's start to have a look at the standards themselves now, and Bella's going to take us through the first section.
Thank you, Lois. Okay, so let's continue with the sustainability standards. Yes, we've talked about the business case and the market case for sustainability reporting, the evolution of the landscape, and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. As we start, it is important to note that there are some key terms that should be understood. You can find the definition in your handout, but I wanted to briefly mention them here. First of all, we will be saying the phrase sustainability-related financial information quite a lot. This can refer to a broad set of issues, including climate, nature, or biodiversity, human, social, or others. In terms of sustainability-related financial information, it is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. And what do we mean by sustainability-related risks and opportunities? They are risks and opportunities that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital. It could affect the company's prospects. We will also often refer to general purpose financial reports, which includes a company's financial statements and management commentary. You might know this as a management report, management review, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use this generic phrase throughout. Anyone familiar with TCFD will recognize the same 4 core pillars or content areas for the ISSB standards. These are governance, strategy, risk management, and the metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the 4 content areas today, but I encourage you to download the standards as part of your homework assignment. So now let's start with IFRS S1, or the full title, General Requirements for Disclosure of Sustainability-Related Financial Information. IFRS S1 sets out general requirements for the content and the presentation of sustainability-related risks and opportunities. And if you are familiar with TCFD, you will see the same architecture applied throughout the standards. And S1 asks preparers to refer to and consider the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities and identify material information. The SASB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. And finally, the standards can be used in conjunction with any accounting requirements. Okay, so the scope of S1 is all sustainability topics except for climate, which is covered by IFRS S2. So the second standard S2 focuses on climate disclosures, building on the same foundations of S1. For example, it fully incorporates the recommendations of TCFD, and it sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And it also requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, this includes both physical and transition risk, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and GHG emissions. Preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2. As we've said already, this is organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. So it's important that S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both IFRS S1 and S2. This is because IFRS S1 sets out general requirements, the parameters for the type of information that needs to be provided in order to make decision useful for investors. And S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. Okay, next, let's consider some of the conceptual foundations that underpin the ISSB standards, which might be new to anyone without an accounting background. These concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. So to start with, companies must fairly present a complete set of sustainability-related risks and opportunities. And also it requires fair presentation that requires disclosures to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. And the reporting entity concept requires to the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. And another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The ISSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between the four content areas, and connections between sustainability-related financial disclosures and the main financial statements. So to better understand this concept, let's look at an example. Over to you, Lois.
Thanks, Bella. Yes, this is our first example today. There'll be quite a few in the presentation. So just to repeat the disclaimer that Fiona gave at the beginning, these examples are to inspire and inform you, but should not be regarded as the best practice or the way to do these disclosures. So this is an example from BHP, which is a mining company. It's an extract from the Operating and Financial Review section of their 2024 annual report. And it illustrates connections between the company's decarbonisation strategy, its financial results, and other processes. The extract is about the impact of the company's climate-related risk assessment and climate scenario analysis on their business and capital allocation plans and their strategy. So what do we find out exactly in this extract? Well, the first paragraph tells us that climate risk assessments and climate scenario analysis are integrated into the company's strategy and treated as a sensitivity in their capital allocation process. So we see connections and alignment between the company's capital allocation plans, the assessment of climate risk, and also the connection with the rapidly decarbonising global economy. Say in the second paragraph, the company tells us that some of their climate assessments are still in progress. They are undertaking studies to assess the effect of future physical climate-related risks on the company's operations, productivities, and costs. So when they get those results, they'll be used to inform and therefore connect with the company's overall risk profile, their corporate planning, controls, and adaptation measures. So in summary, the company is making sure that their climate assessment and scenario analysis are linked to their overall strategy, risk management, capital allocation processes. And you can see in the grey text below that the company is telling us where we can be connected to further information about this and how the climate risks affect other parts of the business. Back to you, Bella.
Thank you, Lois. Okay, so after an example, we have another example. So it's about connected information. Okay, so what information should be considered for connected information? So just to remind that you should select all that you think is right. So this is a multiple choice question. Okay, so what do you think of the connected information? Is it connections between governance, strategy, risk management, and metrics and targets, or connections between sustainability-related financial disclosures and financial statements, or connections between sustainability-related risks and activities? Okay. So let's wait for more seconds. Okay. So I'm going to end the poll and share the results. Okay, you can see the results that 54% choose option A, and 60% choose option B, and the 38% choose option C. Well, if you still remember what I mentioned earlier, I mean before the example, there are three aspects for regarding connected information. So all these three options are correct. We should ensure the connections between the four core content areas and between sustainability-related financial disclosures and financial statements, and also between the risks and the opportunities. Okay, so let's continue. Yeah, and finally, the standards are built on the concept of materiality as defined by the IFRS Foundation. We're going to go into this in more detail later, but just to highlight that we will be referring today to material information, which is information that, if omitted, misstated, or obscured, could reasonably be expected to affect investor decision-making. During the ISSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standard and application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. And also the SASB standards were aligned with IFRS S2 to help preparers seeking industry-based guidance, and the IFRS credential was also updated with more plan to come. I should also note that the IFRS Foundation's capacity building program, which was launched at COP27, is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. Okay, now it's time for another Zoom poll. Okay. So the question is, water is a vital input to our business, but the ISSB standards do not currently have a specific standard on water. What do you do? And just to remind you that this is a single choice question, so which means only one correct answer. Okay. Let's wait for a moment to get more participation. Okay, so now I'm going to end the Zoom poll and share the result. Okay, so you can see the results that there are 64% chose option B, consult the sources of guidance listed by ISSB. And well done, this is the correct answer. I think most of you have answered correctly. Yes, water is a vital input to a business, which means water-related information should be material information for your company, and it should be disclosed in your sustainability-related financial information. But the ISSB standards don't currently have a specific standard on water, but IFRS S1 provides that companies should refer to and have a look at those guidance like GRI standards, CDSB, and also SASB standards. So the right answer is consult the sources of guidance listed by ISSB. And obviously, option A is not correct, and you need to disclose something about water. And I think some of you may think option C and option D is helpful, but for this question, only option B is correct. Okay. So next, I'm going to hand over to Fiona for the module 1 summary.
Thanks, Bella, much appreciated. So as we say, that brings us to the end now of our first full module. So just to recap really so far on a few of the key things that we have covered. So firstly, we reviewed the purpose of sustainability related disclosures. And a key takeaway I think we're hoping that you'll leave this workshop with is that there are important benefits both internally and externally for collecting sustainability related information. So I know a few people have asked the question so far about the fact that maybe reporting is not yet regulated or mandated in Lao. Of course, that's something that, is worth continuing to monitor and may evolve over time. But we hope today to emphasize that actually there's a lot of benefits to applying the ISSB standards on a voluntary basis as well, to meet the needs of international investors and to enhance your own organization's resilience and sustainability strategy. And so if you have also got operations in hard to abate or high impact sectors, it could be that your investors increasingly will want to understand these risks and how you're managing them or capitalizing on opportunities as well. So if this is something that you're not starting to disclose, your investors might start to wonder why you're lagging behind other companies in your sector. And next, we looked at the evolution of disclosure standards and the formation of the ISSB to simplify the reporting landscape. So when you're thinking of voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but rather building on top of them. And finally, we introduced the standards and important concepts that you'll need to understand in order to use the ISSB standards correctly. And a key point to highlight here is that the standards and the guidance are designed to meet the needs of investors, and therefore they're heavily focused on those prospects that we discussed at the very start of the session about focusing on material risks and opportunities that might impact financial performance. Okay, so to wrap up our first module, I should say, we've got a quick Menti exercise for you. And so to introduce the exercise, we want to get you to reflect on the point of defining your objectives or your aims from your sustainability disclosure. So I think what's important here is to be clear on what you're trying to achieve with your reporting and defining what requirements you're trying to meet. So we've talked about maybe there aren't jurisdictional requirements specific to Lao already, but what are the other objectives that are bringing you to report on this, and how do you want to support your reporting to align with those? So this is really about thinking about where your starting point is now as well. So maybe you haven't done any reporting, so perhaps your objective at this point is just to get to a basic level where you have some key information. But if perhaps you're more advanced already, you might set yourself a more stretching objective to align more fully to the standards. So just a quick moment really for each to reflect on what you think that aim is for your organization. So if you have a look at the Menti again, following the link that Lois has reshared with you, you'll see the next question available for you there to answer. And we should say that there's no right or wrong answers to these questions. We really just encourage you to participate, to help you to reflect on what you're hearing, and to start to build out some of the thoughts that might help you to develop that disclosure plan that you'll be able to work through in the homework assignment. Okay, thanks to the first person who's gone and responded. That's always helpful. So this person mentions that they want to be able to make informed strategic decisions that contribute to sustainable development. I think that's a very good framing and a nice succinct way of summarizing a lot in one sentence there. I'll give you all a little moment to have a think about that. I see another response coming in. 2 objectives for this organization or individual. So being transparent and transparency, absolutely. And complying with the standards requirements, yes. Meeting regulatory requirements and possibly investor interest as well. Yes, so I think if you're maybe clear in that focus when you're developing your disclosures on the investor interest, I think, that will be very helpful if you're seeing your investors as your primary audience to have a clear focus in what you're aiming to achieve. A few people have echoed those same points again. I think indeed those are obviously very common areas of focus for many organizations. So I think that's understandable as a focus. So I'll give everyone a few more seconds or minute maybe to answer. We have some time here. It's always good just to reflect, I think, on what you're feeling so far is coming out for you. Industry peers have been mentioned there as well. I think that is also a good point, maybe both within your country, but also maybe in the wider region. There may be other companies who are perhaps advancing on these topics. I know in some of the neighboring markets for Lao, and I know some of you here are from Cambodia as well, particularly, in Thailand, I think, mandatory regulations are coming in. So it might be that if your investors have started comparing you to peers in the region, they would potentially start to expect more disclosure on these topics. Great, thanks everyone for the responses. So someone's also mentioned about building trust and reputation. Yes, definitely, that's great as well. Attracting investors and stakeholders, including employees who focus on sustainability. Indeed, I think that's a very good point to highlight there that, whilst investors might be the primary audience for these disclosures, there are many other stakeholders who potentially will benefit from this. And increasingly, as you say, employees are interested to understand what their company does about these topics. Or maybe when they're thinking about joining your organization, they may look at your reporting to understand that. So managing risks and improving operational efficiency, exactly. Applying best practice globally. Yes, as we say, looking at risks with financial consequences, I think, is an important point. And ensuring alignment between business strategy with disclosures. Yes, definitely. Okay, thank you, everyone. I think that covers a lot of the points that we would have highlighted as well. Of course, these objectives are going to be individual to your organization here, so there's no correct answer as such, but I think what we recommend is just being clear and communicating, particularly with your leadership team, why are you doing this and what's the business case for it, I think is obviously important. So I think as several of you have highlighted, we'd really recommend being clear on that audience who you want to report to, perhaps your investors, and thinking about any feedback that you might have already received for them as well. And of course, we'd also recommend to look ahead to the future. So whilst there potentially might not be regulation that you need to comply with currently, potentially in the future that would change. And so, starting to apply the principles of these standards will leave you in a very strong position if that were to occur in the future and, avoid any compliance risks that you might face in the future. And as several of you have highlighted as well, I think our recommendation is really around trying to maximize those internal benefits at outset as well. So not just thinking of this as a disclosure exercise, but also a real opportunity to internally take that information and use it to help you better manage risks and opportunities. Okay, fantastic. Thank you everyone for sharing those responses. So I'll share the presentation again and I'll pass back over to Bella, who'll take us into the next module.
Thank you, Fiona. Okay, so continue with all the slides. Okay, it's module 2. Now we have introduced the initial concepts. Let's dive into how to apply the ISSB standards, taking into account additional disclosures, including any relevant geographical or sectorial requirements, as well as peer practices and your leadership's objectives. In order to understand how to ensure your disclosures meet global baseline, global standards, we will look at two key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards to achieve a global baseline for disclosure. Once we cover that, we will also discuss how additional disclosures be. Okay, to begin with, let's focus first on how to apply the ISSB standards as the global baseline. So let's get started on the first core content, governance. This includes aspects that relate to the governance body in your company and how management is applied. For each of core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as part of the gap analysis. So if we look at the governance and the management requirements, we can see that there are several questions that you can ask internally, and they are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and procedures of sustainability-related risks and opportunities? And is management responsibility delegated to a specific role or committee? You can also ask internally that how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities. Also, you can ask whether progress against these targets links to executive remunerations. And for more information, you can make use of SSE checklist tool, but remember it's not a replacement for reading and using the full ISSB standards. Okay, so it's time for real life cases. So over to you, Lois.
Thank you, Bella. And here we have an example from a company called Yara from the 2024 integrated report. And Yara is a global crop nutrition company headquartered in Norway with 17,000 employees in 60 countries. So in this governance model, we see that Yara has a very highly integrated model with responsibilities for sustainability embedded across lots of different types of business functions, including risk management, health, safety, environment and quality, human resources, and global climate and energy. We see them represented in the light green boxes in the middle of the screen. So the sustainability governance team itself have a direct reporting line to the Chief Financial Officer, as you can see with the first blue arrow there. And the sustainability governance team are responsible for sustainability performance and reporting. The arrows you see on the screen are used to indicate the flow of information and input between different governance bodies in the organisation, again reflecting the integration of the model and cross-cutting input from different activities. There's also a sustainability network that informs the sustainability governance and other teams. So there are multiple governance models to choose from. This is just one example, and of course each company needs to choose something that is fit for purpose and also suits the particular needs of its company. Let's have a look at another example here. This is from Toyota Industries Annual Report 2024. As I'm sure you all know, Toyota is a car manufacturer including of hybrid electric vehicles. So this extract explains the role of the Sustainability Committee within the company's governance structure. So the Sustainability Committee is one of the business execution committees that reports direct to the President and the Board of Directors. In the extract, we see how frequently the committee meets, once a year or as necessary. We can see who chairs the committee, and in this case, it's the executive in charge of enterprise risk and compliance management, which is different from the Yara example we just saw, where the reporting was to the chief financial officer. The extract shows that the membership of the Sustainability Committee is quite diverse, being made up of executives and managers from different parts of the business. We can see the actions taken during the reporting year to approve action plans on sustainability, targets, activity results evaluation, determine the direction of the approach to sustainability, and that captures the opinions of stakeholders and social trends. So there's obviously the committee is involved in some engagement activities too. So again, an integrated approach from Toyota, and one example of a possible approach to governance disclosures. So handing over to you now, Fiona, for the next section.
Thank you, Lois. Great. Now, with those examples hopefully helping to make governance fairly clear, let's look next at the second core content area, which is strategy. So strategy does have quite a few more disclosures to include than governance, but it's also really where companies can start to see the benefits of sustainability reporting as well. So shown here, you'll see there are 3 high-level areas that we focus on in the strategy content area. So those are risks and opportunities, the effect of those risks and opportunities in different areas, and resilience as well. So we'll talk through each of those separately. To start with, we're going to have a little look. So IFRS S1 and S2 disclosures on strategy are focused on enabling users of general purpose financial reports to understand the company's overall strategy for managing the sustainability risks and opportunities that it faces. So here's some of the questions that you might want to ask yourself internally to support this. So when disclosing information about risks, what kind of detail is required includes a description of what the risk is, what the effects of that risk would be, and the time horizons under which those effects are expected. And keeping in mind, as we talked about at the start of the session, the financial effects of a risk could occur either before it materializes, after, or they could change over time as well. And the last 2 questions on this list in particular look at climate, aligning with the requirements from S2. So for example, investors want to understand what types of risks and opportunities companies are seeing using the categories that have been drawn from the TCFD, as we talked about earlier, so physical and transition risks. And we'll go into that in a bit more detail later. So both the standards as well include accompanying guidance to support companies to identify and disclose risks and opportunities. And they also recommend using industry-based guidance and the ISSB standards as well. So let's have another look at an example here to help illustrate what this could look like. So this example from Mondi Group's integrated report just shows how they are identifying different risks. So Mondi Group is a packaging and paper company that operates across Europe, North America, and Africa. And on the left-hand side, we can see the different risks across the organization that the company has identified. And they've also indicated how those risks align with different categories of risk, so strategic, financial, etc., and also how these risks connect to their strategy. They also then show who in the business has been delegated as an owner for the risk, so a helpful piece to highlight in connection to what we were talking on governance as well. And then on the right-hand side, we also see specifically on climate within the strategic category of risk type that they have, they've further built out an identification of the particular physical and transition risks, as we talked about earlier. And we'll move into showing more information on this, but you can also see that they've applied the parts we talk about as well in terms of disclosing the time horizons of the risks and what those effects could be in terms of the impact on their financial performance. So helpful to see that aspect of the disclosure as well. So you can see here that they have estimated the annual financial impact of each risk, providing a range. And they've also shown when they expect the effects to start to occur on the time frame column there on the right-hand side in orange. So they show sort of the possible range of time frames and when they expect the fullest impact, so the most significant effect to be felt as well, which is useful. So as we started to touch on there, another aspect of risk and opportunities that you'll need to be considering disclosing is what we talked about at the beginning regarding time horizons. So you might remember when I introduced this earlier, that time can be quite a different factor to consider when we're talking about sustainability disclosures. So let's try and be as clear as we can be about what we mean by time horizons. So the ISSB standards ask you to identify within what time horizons any material effects are expected to occur. And how you define short, medium, and long-term time horizons will vary between companies because it depends on quite a few different factors. For example, what your organization's investment and business cycles are, what your strategic planning horizons might be, the lifespan of your assets perhaps, or even other factors beyond that. So whilst there isn't a set time horizon that you need to use, it's important to remember that you need to define it. So your investors won't necessarily know what you mean by short and medium term unless you've kind of quantified that for your own organization. And you can look at some of the examples that we've talked about as an indication of potential time horizons that some organizations might use. But as I say, it's important that that makes sense for what your business's overall approach is and your own risk processes. So moving on to the second group of disclosures in strategy. So we talked firstly there about identifying the risks and opportunities. And this second area is about disclosing the effects of those risks and opportunities. And this is really thinking about exactly what the effect is and where it occurs within the business. So here you might want to start asking yourselves questions such as beginning to describe these effects, understanding any responses you might have planned to mitigate or adapt to them. And again, we know examples can probably help to bring this to life. So this example from BASF is a global chemicals company, and this is intended just to show how they've really shown the different effects of sustainability issues on their business model and their value chain. So in this sort of summary diagram we see here, you can see that they've kind of earmarked both their upstream, their own production, and their downstream value chain. And this is just a quick summary, but it sort of shows how there's different aspects of sustainability that impact each of these areas. So within their upstream, they're thinking a lot about how they can source the relevant materials in more sustainable ways and how they can manage supply chain risks through the practices they implement. In their own production, they're focused on efficiency and process optimization and use of renewable energy to reduce their emissions and achieve cost savings as well. And then finally, when you talk about the downstream side of their business, they talk about their approach to streamlining their portfolio and supporting their global sustainability targets through working with end users of their products as well. So in the commentary that sits alongside this is just a small summary. So we always recommend with these examples to click on the hyperlink in the handout there at the bottom to have a look in detail at the report and follow the page references. But in the detail, they also talk about how they're trying to drive more sustainable revenue growth and kind of integrating circular economy principles. So I think this example shows well how the company's strategy is affected by these sustainability issues and how they're really sort of connecting their sustainability targets into their core organizational goals. So we know that one of the big obstacles companies face when they're reporting on these effects, however, is the level of detail that should be disclosed. And in that example that we looked at there, we were mostly talking about qualitative information. But what about quantitative disclosures? So a company is asked under the ISSB standards to disclose both quantitative and qualitative information about these current and anticipated financial effects. However, the standards do also provide criteria for when only qualitative information is required. So a company may choose to provide only qualitative information or a mix of quantitative and qualitative in a number of cases. So firstly, if they can't separate the effect of a climate-related risk or opportunity from other types of effect, or if there is a high level of measurement uncertainty. And finally, this is also allowed if the company doesn't currently have the skills, resources, or capabilities to provide that quantitative information. Okay, so that brings us to the last part of the strategy component. So firstly, we've identified the risks, we've thought about how they're going to affect the company, and this part here is about looking particularly at how the company is prepared for uncertainties and ensuring its resilience to the future. So in this area in particular, we're talking about the processes of scenario analysis and resilience planning. So disclosures here are focused on understanding what types of assessment a company might have used and if and how they've utilized scenario analysis. So we'll dive deeper into scenario analysis in a moment, but some of the questions to start considering asking internally when you're disclosing this area is thinking about, what is your capacity as an organization to react or adjust to any uncertainties that you've identified or any risks maybe? And thinking about as well if and how you could use scenarios to better test this. So let's have another look at an example. So here we have Stora Enso, which is a Finnish and Swedish forest products company. And what we're showing here in this diagram is how they've really identified their uncertainties that arise for them as a result of their strategic changes in direction from sustainability issues and the potential impacts this might have on their decision making. So they kind of illustrate in their report that their current sort of core business relates to forests, pulp, and wood products, but that in the future, they're expecting their strategic growth to come from different areas. So building solutions, renewable packaging, and biomaterials. So what they've also shown in the diagram at the bottom is how their sales is shifting already to start to be more focused on these strategic growth areas, but that actually when they're looking out to 2030, they're projecting that these strategic growth areas will represent the majority of their business at this point. So this gives a good sense of how the company is thinking about different futures and how it's potentially positioning itself now for that long-term view in 2030 of what its new business might look like. And our second example here is from Solvay, which is a Belgian chemicals company. And here we wanted to draw out how they've reported the financial effects and the assumptions that underlie their scenario analysis. So particularly, we want to highlight that they're transparent about the estimates that they use and how they've developed their scenario analysis. So if you're using a tool like this, investors need to know how you've used it. So you can see in this disclosure excerpt, they've provided the assumptions they've used, which areas of the business they've assessed, and highlighted, how internal experts have worked with consultants to conduct the assessment. And then in the bottom table, we show the financial impacts that they've identified for their business. And they've used two different climate scenarios here, a 1.5 and a 3-degree scenario. And they've shown using a sort of qualitative scale from -3 to +3, what level of effect they're expecting to see under these two scenarios for different aspects of their operations. So a useful disclosure on how they can see what those effects of the risks might be. Okay, so just to test everyone's listening and understanding from what we've just covered there, a quick poll question again for you, which I'll just launch. So the question we have now relates to something I covered a couple of slides ago, just to check if you heard that point. So it's asking what are the reasons that a company could choose to disclose qualitative information rather than quantitative information or a mix. So we talked about a couple of possible reasons that the standards would allow for this. And so select as many of those options there as you think are valid reasons to provide qualitative information. So the first option being if you can't separate the effects of climate risks from other effects. Secondly, if there's a high level of uncertainty, perhaps in the measurement of any quantitative effects. Or the final option is if the quantitative information sheds negative light on the company. So take a moment and let us know which of those you think, or one or two perhaps, are valid reasons. Okay, I see numbers are slowly creeping up. I know it's good to sometimes just give everyone a moment to think about this. So I'll give you a few more seconds before we look at the right answers. Okay. I'll maybe close off there because I think we've slowed down a little bit and share the results with you. So for those of you that answered, most of you got this correct indeed. So the top two reasons there would be valid reasons why you might have to disclose qualitative information. However, the final option there is not a correct answer because, of course, it's very important to provide balance and transparency in your reporting. So if you do have information that allows you to quantify both negative and positive impacts, it's important to be transparent about that with your investors and stakeholders. And I think in those two examples that we talked about there, particularly the Solvay example, you can see that they did disclose both negative and positive financial impacts, so provided that balance of information. Brilliant, thanks everyone. Okay, over to you, Lois, for the climate side of things.
Thank you, Fiona. The governance requirements we looked at are very similar across S1 and S2. There are no specific additional requirements for climate in relation to the governance core component. However, when disclosing information related to strategy, all that we've just been told by Fiona applies equally to climate, but there are some additional requirements in S2 regarding climate. So let's have a look at those now. Now, the title of this slide, From TCFD to ISSB Strategy, is designed to help people using TCFD to understand differences with ISSB. However, if you're not using TCFD, don't worry, because this list applies to every disclosing company using S2 and wanting to understand the climate specific aspects of the strategy disclosure component. So for strategy in S2, companies are required to refer to and consider the applicability of industry-based disclosure topics. Now, those topics can be found in the industry-based guidance on identifying climate-related risks and opportunities. That's a separate document from S2, and it's available on the IFRS website. And it includes sector-specific disclosure topics. So, for example, if you are a manufacturer of personal or health products, one question that might be asked of your sector is whether you use palm oil, and if so, where it is sourced from. Secondly, S2 asks for information about where in the business model and value chain risks and opportunities are concentrated. So this might apply where you have physical aspects that are particularly vulnerable to physical risk, for example. Thirdly, it asks for detailed information on the effects of climate-related risks and opportunities on the business. And this will include disclosures about how a company has responded to or plans to respond to the identified risks and opportunities. And such a response might include the development of a transition plan, which we'll come on to look at later, or how the company plans to achieve any targets that it's set. Then the S2 asks for disclosures about the current and anticipated effects of climate-related risks and opportunities on the company's financial position, performance, and cash flows, as we've seen. S2 sets out criteria for when quantitative and qualitative information is required. So because the standard recognizes that it can be difficult to provide quantitative information, It sets out circumstances in which only qualitative information is required. For example, when a company cannot separately identify the effects of a risk or opportunity, or when the level of measurement uncertainty is too high. Again, recognizing that some of these requirements are difficult to respond to, the standard says that when preparing disclosures on the anticipated financial effect of climate-related risk and opportunity, a company is only required to use all reasonable and supportable information available to it at the reporting date without undue cost or effort, and can use an approach to estimating the financial effects that is commensurate with the company's circumstances, its employees, systems, processes, and so on. Then the penultimate point is about scenario analysis. S2 requires company to use scenario analysis for assessing the resilience of the business to climate-related risk and opportunity. But the standard does not specify the particular scenarios to be used. That is for management to determine using its judgment. Finally, S2 requires information about business resilience and disclosures about business resilience, including what significant areas of uncertainty have been considered by the company in its assessment, whether and to what extent it has a capacity to adjust and adapt its strategy and business model over time. And of course, details are required about when and how scenario analysis was used. So I just mentioned that the development of a transition plan can be one response to climate-related risk and opportunity. So if you have a transition plan, S2 requires that you disclose details about it. However, there's no requirement in S2 for a company to develop or have a transition plan. But if you do, let's have a look at some aspects of this. Well, first of all, a transition plan is defined in S2 as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including, for example, greenhouse gas emissions reductions plans. So let's think of some of the characteristics a transition plan should have. Well, first of all, as an aspect of the company's overall strategy, the transition plan should align internally with that strategy, with the business case and motivation for setting the strategy, and with decarbonisation levers that are most economically and technologically feasible and suited to the company for decarbonisation activities. Secondly, the transition plan should be aligned with science, including what science says about requirements for net zero to be achieved and how carbon neutrality or Paris-aligned goals are explained in terms of the science. Thirdly, the plan should set long-term goals in accordance with the time frame of the transition plan, and those goals should be supported by activities and targets to achieve those goals, as well as mitigation and adaptation activities and plans. Of course, the transition is uncertain. None of us can be quite clear on how it's going to develop, so the plan should be transparent about any risks and challenges associated with execution of the plan. It should be transparent about the dependencies for the plan's progress and success, and also set out the risks and challenges of implementing the plan and how any residual or unabated greenhouse gas emissions will be treated. The transition will proceed in different ways for different sectors, and therefore it might be helpful to look at sector-specific pathways for the transition, and they could help inform the development of the transition plan, and we're going to look at some resources that help with that in a moment. And finally, companies should consider how the transition plan will be evaluated by investors and others to ensure that the plan has the hallmarks of credibility that are set out in various frameworks and documents. So let's think about some of the resources that can help you determine what's a credible plan, what are sector-specific pathways, and so on. Thank you to Fiona for providing other useful documents in the chat. There are lots and lots of transition plan resources, and really this is just a very small selection of them. The transition plan resources that we're talking about here are produced by the Glasgow Financial Alliance for Net Zero, or GFANZ, and the Transition Plan Task Force, whose work has now been incorporated into the IFRS Foundation. The triangle on the left shows that each of these resources are designed to be mutually reinforcing and to support each other. So in the middle of the screen, you can see some resources from the Glasgow Financial Alliance for Net Zero, and these set out expectations for real economy and financial institution companies, but also set out some sector pathways that could be helpful if you're trying to understand the transition and how it will unfold for your sector. And of course, the resources of the TPT, Transition Pathway, Transition Plan Task Force are also in the little thumbnail there, and they're available on the IFRS website, which we'll show you later. So you'll be pleased to hear that we're now going to take a short break. It's a 5-minute break when we'll play you some relaxing music. So please take the opportunity to have a stretch and a drink, but also please ask us any questions you might have and enter them into the Q&A box. You've got 4 experts here that are ready and willing to help you. So I wish you a restful break, and we'll see you back here in 5 minutes. Hello, everyone. Welcome back from your break. Hope you had a chance for a stretch and a drink, and we're going to continue now with the next core content area of the ISSB standards, and this is risk management. So you can see from the high-level description here, this category of disclosures requires report preparers to disclose information on their processes for risk management, as well as whether they have been incorporated into their overall risk profile. So there's a bit of a different emphasis here. The previous core components that we've looked at cover information disclosure, whereas this is about disclosure about process. So what the standard is asking for is information about what processes and policies the company uses to identify, assess, prioritize, and monitor sustainability-related risks and opportunities, and whether those policies and processes have been integrated into the company's overall risk management process. So the sorts of things you might want to consider about your processes are: what are the inputs and parameters you use for sustainability risk management? Are sustainability risks and opportunities prioritized, and what is the process for doing that? What criteria are used for the assessment of sustainability related risks and opportunities? Is it just probability, or are there other criteria such as likelihood and magnitude? How do you monitor? What process is used for monitoring sustainability related risks and opportunities? And when and how are changes made to these processes? So beyond that, of course, we know that the standard also asks about how these things have been integrated into the company's overall risk management process. So, as with the strategy component, we do have some climate-specific considerations that apply to risk management in IFRS S2, and we're going to look at those now. Again, don't worry too much about the title from TCFD to ISSB, because this list applies in any event. So the disclosure requirements in S2 require detailed information about the input parameters used to identify climate-related risks, and whether and how scenario analysis was used to inform risk identification. As you know, from the strategy component, scenario analysis is mainly to assess business resilience, but can be used to inform risk identification as well. And the standard asks about any changes to risk management processes. And the same applies to climate-related opportunities. In IFRS S2, we do have definition of climate-related risk, and this definition helps companies to be aware of what they should be evaluating. The definition of these risks is based on the TCFD's work. There are two types of risk. Transition risk arises from efforts to transition to a lower carbon economy, and in turn are often categorized as policy and legal, technological, market, and reputational risks. You can see some examples of those in the middle of the screen. So transition risks could take the form of increased pricing of GHG emissions, enhanced reporting obligations, exposure to litigation. There could be costs associated with the transition to lower emission technologies. Transition risks might come from changing customer behavior and demand for different products and services. Market signals may be uncertain. Raw materials may increase in cost or change in terms of their availability and quality. All sorts of transition risks. The second type of climate-related risk is physical risk, and there are two main types of physical risk. Acute physical risks are event-driven and arise from weather-related events such as storms, floods, droughts, or heat waves, which are increasing in severity and frequency. And chronic physical risks arise from longer-term shifts in climatic patterns, such as changes in rainfall, temperature, sea level rise, reduced water availability, biodiversity loss, and changes in soil productivity. We see some examples of that in the middle of the screen at the bottom. Now, in both cases, these types of risk can give rise to various effects, reputational and strategic effects, of course, but also financial implications for the company, such as costs resulting from direct damage to assets from physical risks or indirect effects of supply chain disruption. And the company's financial performance could also be affected by changes to resource availability or temperature changes that perhaps mean that construction workers can't work outside for such long periods, that type of thing, and those financial effects manifest over different time horizons. In S2, we also have definitions of climate-related opportunities, and these refer to the potential positive effects arising from climate change for a company. And you can see the types of opportunities listed here. They can come from being more efficient with the use of resources, turning to lower carbon energy sources, developing new products and services, perhaps in response to consumer demand for more climate-friendly products and services, accessing new markets, or enhancing the company's resilience to climate-related risks and opportunities, being able to differentiate yourself from competitors, and so on. Again, in this case, the financial effects may be felt over different time horizons and may affect cash flows, access to finance, and cost of capital. So the financial effects could result, for example, from increased revenue from new products. Let's have a look at a real-life example now. This is an example from the RS Group's Annual Report 2024. And the RS Group is a UK-based distributor of electrical and industrial equipment with global operations. Now, this company has analysed their climate-related risks and opportunities for a number of years as part of their annual report disclosures. Elsewhere in the report, they've identified 10 principal risks, one of which is climate change. And here we see an extract that describes the physical risks from climate change to their business. The most significant physical climate-related risks relate to the impact of extreme heat on their distribution centres, and you can see that on the first row there. And the other main physical effect is the potential for extreme weather events to cause physical damage and disruption to their customer supply operations. You'll see that there's a little red wheel in each of these rows, and that indicates the effect of the risk on the company's strategy. And also you can see some little icons that describe the connection to the stakeholder effects. So they've identified how these risks affect their connected stakeholders. Going forward across the extract, you can see who is the business owner of the risk concerned, how the risk is described, what metrics are used to monitor the risk, and in the final column, we see the actions that the company is taking to respond to mitigate and adapt to the risk. So these types of actions include things like building upgrades, as you might expect with a physical risk assessment, but also they describe the associated capital investments they're making for those building upgrades and other things, and also how they've enhanced their business continuity planning. So with that example explaining risk and risk processes, let's hand over to Bella for the next core component.
Hi everyone. It will be actually me taking over from Bella. She had some technical problems, so I'll continue from now on. No, yeah. Hello everyone. Yeah, and thank you, Lois, for this section. And we'll be now moving to the next core content of this training, and that'll be metrics and targets. And so we'll cover it a bit more in details. So we'll start with metrics. requirements and metrics are designed to enable investors to understand companies' performance in relation to its sustainability-related risks and opportunities. So preparers shall disclose information explaining how the metrics are defined, if they're absolute or relative, if they have been validated by a third party, as well as the methodology. So, for example, the method calculation used, the inputs, the limitations, and assumptions involved in disclosure of these metrics. So that's about metrics. The other component, it will be targets, or the other element. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals. So disclosures should include following characteristics. So whether the target is qualitative or quantitative, whether it's set voluntarily or it's required by the law or regulation and in which the entity operates. The metric used to set the target and to monitor progress towards its achievement, the baseline period in which progress, from which progress is measured, and period in which the target applies, and what are the milestones and interim targets. If there have been a revision to the target, together with an explanation, there should be an explanation about this revision. And we have another example here to how the targets and metrics can be used in practice, and handing over to Lois again.
Thank you, Robert. This is an example from a company called CLP. It's in their Sustainability Report 2024. And CLP is one of the largest investor-owned power businesses in Asia Pacific and aims to be a leading responsible power provider. So this extract is all about targets on waste management and material use. And it's how those targets are being met as at 2024, the targets having been set in 2021. So as you can see at the bottom, the targets explain the waste and material reductions, so waste pollution reductions. And these reductions are set within the context of the company's circular economy strategy and principles. So that strategy is set out in the text you see at the top of the screen. So all these targets are contextual, set within a context. If you see right at in the light grey text in the first panel, you can see that the metrics have been calculated in line with the ISSB and GRI framework. So immediately we know why the companies set these targets, because it's in line with their strategy, and we know how they have calculated them according to ISSB and GRI frameworks. We also know the baseline year, which is 2021. So if we have a quick look at the table itself, we'll see that the 2024 results show 100% achievement of the target, except in relation to waste products. But you can see that the target is really near to the target they want by 2030, which is a 70% reduction. And they also explain why this target is slightly ahead of their projections in the narrative. And the explanation is that they have divested a particular company. So let's having looked at a real life example, a different one from climate, this time on waste management, let's hand back to Robert for climate specific considerations.
Yes, indeed. Thank you, Lois. Yeah, we'll be now looking at some climate-specific considerations for disclosures on metrics and targets. And then let's look first on the relationship with TCFD and how that's being now covered within IFRS standards. So the TCFD framework included recommended disclosure, which IFRS S2 builds on and adds to as a part of required disclosures. So for example, IFRS still requires disclosures of industry-based metrics relevant to a company's business model and activities. Additional disclosures are required on greenhouse gas emissions, including separate disclosures for the consolidated accounting group and associated joint ventures, and information about companies' financed emissions. In addition, IFRS S2 sets out a Scope 3 measurement framework to provide guidance on preparing Scope 3 greenhouse gas emissions disclosures. While what is important to remember, why IFRS S2 does not explicitly require a company to disaggregate its greenhouse gas emissions disclosures by their constituent gases, IFRS S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such a disaggregation provides material information. So I would like to remind also everyone that you can access more information on climate metrics in the SSE's training tool on this topic. We will share the link in the chat, and you can also find it on the SSE's website. All right. So we talk about metrics in the context of TCFD. Now let's move to the targets. And likewise, there are some additional requirements here as well compared to TCFD for targets as well. So for example, IFRS S2 requires disclosure about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. And additionally, IFRS also requires disclosures of more detailed information on greenhouse gas emissions and targets, including additional information about any planned use of carbon credits to achieve companies' net emission targets. And finally, IFRS S2 also includes additional requirement to disclose information about approach to setting each and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. All right, so these were the elements, and then the comparison between TCFD and ISSB standards. We now move to the we talk about more in detail about greenhouse gas emissions metrics. So these questions on greenhouse gas emissions often come up in questions on metrics and targets disclosures. So we want to address them here again. And so for those who might not be familiar with the different scopes, we have 3 different scopes, 1, 2, and 3. And scope 1 includes all direct emissions that occur from sources owned or controlled by a company, such as emissions on facilities or vehicles. The scope 3 includes emission from generation or acquired and consumed electricity, steam, heat, and cooling, such as the electricity the company is purchasing. And scope 3 will be then all other indirect emissions that occur in the company's value chain. And in that context, S2 requires a company to disclose its absolute gross scope 1 and 2 and 3 greenhouse gas emissions in accordance with the greenhouse gas protocol corporate standard, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using a different measurement approach, there is a transition relief to use that method in the first year of applying the standard. Whether and how the company is using internal price on carbon for decision making, that's another requirement to be disclosed under S2. And finally, whether and how executive remuneration is linked to climate change. And again, on this topic, we'll have another example. Over to you, Liz.
Thank you. Yes, this example about disclosure of greenhouse gas emissions is from Enel, which is an Italian producer and distributor of electricity and gas. And this extract comes from Enel's 2024 GHG inventory, and they produced their GHG inventory as a separate document. And it starts with a description of the company's ambition to achieve net zero emissions by 2040 and to promote energy generation from renewable sources. At the top of the slide, you can see that the company's carbon footprint is broken down by the different scopes that Robert's just described, scope 1, 2, and 3. You can see that in the blue, solid blue graph bars, we can see the results for 2024. And in the shaded graph bars, we see the 2022 results. So as well as there being a breakdown by scope, we see a comparison across the years 2022 to 2024, and this enables us to see a trend, and the trend is that the emissions are falling. At the bottom of the slide, we can see an extract which shows the breakdown of scope 2 greenhouse gas emissions. So how has the company disaggregated or broken down the scope 2 emissions? Well, firstly, they've broken down by business activity. So the power generation and others activity is just one of their business activities. The other activities in this part are power distribution and real estate management. They also break down the emissions by source. So you'll see the emissions come from electricity consumption from the grid in power plants and from electricity consumption from the grid in terminal ports in particular locations. Next, we see the comparison of results 2024 compared to 2022 and the percentage reduction. We also see a breakdown by calculation method. So if you look right at the top there, you see it's location-based versus market-based. The location-based method reflects average emissions intensity of the local electricity grid that the company is connected to. And the market-based method reflects emissions from electricity based on the contractual terms that the company has entered into with the electricity provider. So quite a lot of information in quite a small example there. So let's have a look at another Zoom poll now. We really welcome your participation in this. The question is, what is the objective of metrics? In particular, what's the objective of the disclosure requirements on metrics in the ISSB standards? Is it to understand performance in relation to the entity's sustainability-related risks and opportunities, to understand progress towards targets, or to understand the company's assumptions for the future? Give you a minute to think about that. Yes. Let's share the results now. So most of you have answered A and B, and that is in fact correct. Of course, metrics might help readers to understand the company's assumptions for the future, but the reason for asking you the question in this way is to encourage you to read the standards themselves and to draw your attention to the fact that each disclosure component starts with a description of the objective of that component. So the objective of the metrics disclosure requirements are to help readers understand the company's performance in relation to its sustainability-related risks and opportunities, and to understand progress towards any targets. So understanding the objective of each of the disclosure requirements can help you to craft your answers more effectively. So let's move on now to the next part of the Align module. And this is about how you make additional disclosures, that is additional to the global baseline that we discussed earlier. How do you build on that baseline? Well, you might want to or have to build on the global baseline reflected in the ISSB standards because there are local listing requirements that apply to you and that are jurisdiction specific or stock exchange specific, and these might also affect companies in your supply chain. There might be policy objectives that you want to or have to reflect or respond to in your disclosures, and these could be policies that offer things like incentives or tax cuts or subsidies for sustainable practices, or disincentives for activities that are counter to national objectives on sustainability. You might want to or have to make additional disclosures to align with industry standards that apply to your sector, or to satisfy the information needs of stakeholders other than investors. For example, to satisfy the needs of stakeholders that are interested in information about impacts of business activity as well as risks and opportunities. Now, as we saw earlier, the IFRS Foundation is working with jurisdictions around the world on adoption or voluntary use of ISSB standards. That work is gaining momentum. When we last had an ISSB board member on one of these training sessions, she said that there are 35 jurisdictions adopting or taking steps to adopt ISSB standards. The IFRS Foundation offers dedicated support to jurisdictions in doing this as part of their regulatory implementation program. And if you would like to know more to see progress on jurisdictional consultations on adoption of the ISSB standards, there's a link to the website, the IFRS web page that deals with that on this slide. So because companies do make additional disclosures and because they're already responding to other types of frameworks, as we saw in your answers earlier, the ISSB wants to work with other organizations and build strategic relationships to support what they call interoperability, so that different standards and frameworks work well together. So as we saw earlier, the CDP has aligned its climate questionnaire with IFRS S2. The GHG protocol is the protocol that must be used for the measurement of greenhouse gas emissions according to IFRS S2. And the ISSB works closely with the GHG protocol team in two respects. One, to be engaged in any updates to the GHG protocol standard on the technical side, but also participates in GHG protocol team's governance arrangements. We've already seen that the ISSB works closely with GRI. We'll look at that again in a moment. We know that Transition Path Task Force work has been adopted into the IFRS Foundation's work. And ISSB is working closely with the Task Force on Nature-related Financial Disclosures to build on the TNFD's recommendations. We've already talked about this a bit, the ISSB and GRI working so closely together. They've already completed one exercise, which is to look at how interoperable their climate requirements are, particularly on greenhouse gas emissions. And they found that there was quite a high degree of alignment. They're committed through a memorandum of understanding to jointly identifying and aligning common disclosures. This is going to be reflected in the ISSB's project on biodiversity ecosystems and ecosystem services, where they're collaborating with GRI to build on their GRI 101 biodiversity standard. And in terms of governance, the IFRS Foundation is a convening partner of the GRI's Sustainability Innovation Lab in Singapore. Now, it might not apply so much to this audience, but many of you may be aware that in Europe there is the Corporate Reporting Sustainability Directive, which requires companies within scope to make sustainability disclosures using European sustainability reporting standards set by the European standard setter known as EFRAG. Now, those European sustainability reporting standards have many content elements in common with the ISSB standards. So ISSB and the European Standard Setter are working closely together to reduce complexity and duplication between their standards and to ensure a seamless reporting environment. There are some differences, of course. The European standards cater for information needs of stakeholders beyond investors. So again, we'll have information requirements on impacts as well as risks and opportunities. And the ISSB standards have some additional requirements, i.e. additional to those found in European standards, and these include additional requirements on things like financed emissions applicable to financial institutions. But the organisations are working closely together and have already produced one comparison document that shows a high degree of alignment between their requirements on climate-related disclosures. We saw at the beginning that some of you are using integrated reporting, and we also saw that the integrated reporting framework has been incorporated into the ISSB's work. So just to let you know, there is this Getting Started guide available on the IFRS website, and this shows how the integrated reporting framework can be used with IFRS S1 and S2 as a complementary tool. The integrated reporting framework supports this holistic view of the value creation process and can be used to support sustainability disclosure. There's quite a lot in this document, some dedicated frequently asked questions on integrated reporting, a mapping tool, and of course a getting started guide. Perhaps the most important thing to say about integrated reporting, though, is that it's supported by integrated thinking, which really enhances the quality of a company's corporate governance. Just going to do one Zoom poll now, I think, before we move on. So we've seen that ISSB standards represent a global baseline, but there are other frameworks that can be used. So when you consider your disclosure objectives, should you consider the ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or the ISSB standards, regulatory requirements, and other sources of guidance? It's a single choice only here, as you can probably see. Quite rapid responses to this question. A clear pattern has emerged, so I'm going to share the results. Yes, of course, you're right, completely right. You can consider the ISSB standards, regulatory requirements, and other sources of guidance, CDP, GRI, European standards, etc., as you consider the disclosure objectives for your company's report. So, handing on to Fiona now for the Module 2 summary.
Great, thank you so much, Lois. And as you say, that brings us to the end of Module 2, which I think I mentioned at the start is the largest module in the training. So we're well over halfway, as I say, in the content. Our third and fourth modules are quite small. So if it feels like there's been a lot to take in with this module, it's because it's really quite a bulky one in terms of the substance, but we hope helpful to really provide that strong overview of as well. So in this module, we reviewed all 4 core content areas of the ISSB standards. That's governance, strategy, risk management, and metrics and targets. But an important thing to remember here, of course, is that these don't operate in silos. So we saw in those example disclosures from companies across those different areas that although there might be 4 separate categories of disclosure, in practice, all of those areas are interconnected, and we see that in the way that companies are reporting. And we also discussed how your disclosure might go beyond the requirements of S1 and S2. So for example, to meet the needs of different stakeholders or to meet the requirements of industry standards, for example. And what's important to remember when you're doing this is that the ISSB standards have been purposely developed to act as a baseline. And the building blocks approach does allow report preparers to add additional disclosures on top. But in doing so, it's also important to be careful not to obscure the requirements of S1 and S2 as well. Okay, so to consolidate all of that, we'll be going back to another activity to end the module. So here we want to think a little bit about the key gaps that you need to address in your current disclosures and internal processes. So you've probably, from all the content we've talked about now, hopefully been able to reflect as we went along. Perhaps there are some things that you already do well in your business, or maybe there are some aspects that we've introduced today that would be completely new to you or might require a new process. So what we'd like you to do in this exercise is just to reflect on what immediately comes to mind for you as the key gaps. So this could be both particular reporting content or topics of disclosure, but it could also be processes or skill sets that you might need to develop internally as well to support this. And overall, this is just a quick reflection exercise to see what's front of mind, but we do really recommend that conducting a more thorough gap analysis is a great starting point in this area. So within that homework handout exercise that we've shared with you, there'll be a more detailed checklist there to help you identify these gaps. And also within the SSE toolkit that we've mentioned already, there is further a checklist there that can help you to do this gap analysis in more detail. But if we want to go back to Menti, so I shared the link again with you in the chat before, and we'll share screens now together to have a look at your responses. The question I'd like you to think about just while we're waiting for your responses to come through is around, yeah, really that point that I just summarized there. So what are your key gaps that you need to address in disclosures and internal processes? So just feel free to share anything that you're thinking of here. I think it's always useful for peers of your organization to understand if you're all grappling with the same gaps or maybe if you have different issues as well. So don't be shy. Please feel free to let us know your thoughts. We're taking a moment to have a think, but I would encourage you to share. Don't be shy. It's always nice for us to get that engagement and know that you're reflecting on what we're covering so far. As I said, there's no right or wrong answers here, but we do encourage you to participate in this as part of the learning opportunity. Some things, I guess, that we know many organizations often mention here is that data management can be a big gap. And I think that's come through indeed in the first response that we've had. So, actually accessing quantitative data on these topics can often be, quite challenging. So that's understandable. And someone's also mentioned sensitivity analysis. So yes, that kind of concept that we saw about assessing uncertainties, looking at resilience, often very new for organizations. And it, frankly, may not be the first starting point to begin with. It's something that you'll probably want to work towards in time. And if you look within the ISSB materials as well, you'll see there's recommendations there regarding, perhaps starting with a quantitative approach to sensitivity or scenario analysis and progressing towards more quantitative methods over time, but starting qualitatively. Yes, so several people have mentioned data and maybe also documentation, as you say. So if you're going to be building processes to collect data, do you have the documents to record that, perhaps you're referring to, or maybe just documents that you can collect as well to understand different aspects of risks and opportunities. So understanding what information you have available. People have mentioned knowledge and skills, definitely something that takes time to build. Sometimes it's a case of working with accounting colleagues as well, because actually, their skill sets, and I'm sure some of you here today come from that profession, but I think your skill sets are very well suited to this field of disclosure, but equally that needs to be combined, of course, with individuals who understand the subject matter. So getting that right mix of skills into the organization is often something to consider at this point. Or maybe just not having the resource, as someone's mentioned, indeed. So I think I know it's been mentioned several times, and I think I see it here, that because the standards are not mandated in your jurisdictions yet, perhaps it's not always easy to make the case for needing more resource. But we hope that some of the arguments that we bring through today in the training, evidencing that investor interest in these topics, evidencing that a lot of companies are starting to report this information across the world, can show that actually if you're looking to the future in terms of direction of travel, now is the time to really start to get some of those principles in place and to understand your gaps and resource requirements in readiness for future reporting regulation. Too complicated, of course, is often a challenge, and people have mentioned limited resources again, or maybe how to compare information. Indeed, also possibly challenging. Great. Thanks everyone for sharing. I think what we really wanted to do here is just a quick reflection. And we know we can't necessarily solve all of your gaps with you today, but I think what's important to try and do in this gap assessment is to set some prioritization against key areas. So, maybe as many of you have mentioned here, it's quite early in the adoption process in Lao and other markets nearby. But I think prioritizing some of those points around your organizational skill sets, how to start improving and understanding data will be the great places to start to build preparedness. So that's really useful to get a sense from you all. So some things we'd encourage you to do is to really start to map this out a little bit with your colleagues and think about how you might start to improve and evolve and iterate as your reporting matures. Okay, perfect. Thank you for sharing that. So I will put the presentation back up and pass it on to Lois for the next segment.
Thank you, Fiona. So we're now going into a brand new module, module 3, which is called Implement. And so far we've looked at what to disclose, what the ISSB standards tell us what to disclose in reports, but there is some information in the standards about how to do that too. So we're going to look at more of the how type questions in this module. There are 3 sections to it. First of all, how to identify sustainability related risks and opportunities. I'll take you through that. Then Fiona's going to talk to us about evaluation processes where there's uncertainty. So in particular, we're going to look at some scenario analysis examples and also evaluation processes for scenario analysis. And finally, we're going to look at how to integrate sustainability related financial information into your reports and reporting. So let's start with identifying sustainability related risks and opportunities. Well, IFRS S1 asks companies to provide material information about all sustainability related risks and opportunities that could reasonably be expected to affect a company's prospects. And S2 sets out the climate-related disclosure requirements. But what about risks and opportunities beyond climate? And S1 directs companies to different sources of guidance that can help them identify risks and opportunities other than climate, and also help them to understand which information to report. So first of all, when identifying which sustainability-related risks and opportunities to report beyond climate, S1 says that companies shall consider ISSB standards. These are the sector-specific standards we've already mentioned. And in addition, companies may consider other materials, including the IFRS new educational material on sustainability-related risks and opportunities and disclosure of material information. That new guidance is very helpful. You can also look at the Climate Disclosure Standards Board Framework Application Guidance that has information on how to disclose on biodiversity, human rights, and other things. Industry practice or industry standards could also be used to help, and the materials of other investor-focused standard setters, and that would include the Integrated Reporting Council. What information to to supply when you have identified your risks and opportunities is also explained in the standards. The same sources of information can be used, but in addition, you can look at GRI standards and European sustainability reporting standards. If you remember from the example we looked at earlier, where CLP had reported against their targets on reducing waste pollution, they had used SASB standards and GRI standards for the disclosure of that information. So that's an example of how you might apply this guidance. Let's have a look now at an example from a company called Ayala from their integrated report on how they identify sustainability related risks. Ayala's based in the Philippines. It's a huge conglomerate company, lots of diversified interests and industries in banks, healthcare, technology, and so on. So this is an example of how the company has identified risks. We can see that they've started by having a communication and consultation exercise where they have looked at inputs, insights, and recommendations on how to improve and manage their risk management action plans at various stages. So that gives them some context for the 4-stage exercise they then complete. Part 1, they establish the context. So they look outside at external factors as well as internal factors that affect their identification of risk. And the person in charge of that, or the team in charge of it, is the enterprise risk management team. They then identify, analyze, and evaluate risks and prioritize them within the business. They then move on to deciding how they're going to treat those risks. So what's going to be the risk treatment plan? What actions will they take? And here the risk owners, supported by the enterprise risk management team, are in charge of the risk treatment. And finally, they have a monitoring and review stage of their risk identification and treatment plan so that they know how they're going to keep track of the risks that they have identified and monitor them over time. I'm going to look at another example now, and this example comes from a company called Nest. Nest is a company based in Finland, and it's a leading producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. So it has a business model that is based on sustainable solutions. This extract comes from the climate section of the company's annual report and shows a different way of looking at risks and opportunities. In particular, the company looks at risks and opportunities using 2 scenarios, the net zero scenario and the compromised climate targets scenario. The net zero scenario is described as one in which we see rapid and radical emissions reductions globally with limitation of global warming to 1.5 degrees C. Now, they split the way in which they look at this particular scenario between global, the world, and Europe and North America. And that's because countries and jurisdictions, areas take action at a faster pace than others in some situations. In both cases, the company anticipates opportunity from the growing demand for renewable and circular solutions that they offer. So on a global basis, they believe that they can expand into new markets and opportunities as an opportunity. And in the EU and North America, they expect their supply of renewable and circular solutions to be supported by regulatory and voluntary ambitions. Of course, they also identify risks in these scenarios too, associated with competition and acceleration of new technologies. Of course, the risks look different in the compromised target scenario, where they describe this as being where climate action is slow and global warming of 2.5 to 3 degrees C is expected. So on the opportunity side, in this case, the company can differentiate itself from others by providing renewable and circular solutions. But the risk is that in the compromised world, the demand for the products is constrained. Last thing to say about this example is at the bottom of each scenario analysis, we see the indicative financial impact of the risks and opportunities on NEST, the most positive financial impact being in the net zero world 2050 scenario. And maybe that's to be expected for a company that has a business model based on the development of renewable and circular solutions. So, as I said before, scenario analysis primarily to be used for business resilience assessment, but here has also informed the landscape of the company's risks and opportunities. I'm not going to go through this next slide in detail because we've already talked about this, the fact that the standards recognise that identifying and reporting on risks and opportunities can be difficult for some companies, so allows companies only to use all reasonable and supportable information available at the reporting date without undue cost and effort. But what does this mean? It means that the information is specific to the company. So not just a generic statement that climate change will affect the company, but give specific details about how it affects the company. It also takes account of the external environment. We saw that in the example earlier, where one of the steps in the risk process was to look at the external environment. The use of reasonable and supportable information includes information about past events and current conditions, which will already be known to the company, but also forecasts, which perhaps is informed by scenarios. And in some cases, what is reasonable and supportable is actually specified by the sustainability disclosure standards. So we're going to move on to the next part of this module now with Fiona.
Thank you, Lois. Great. So that brings us in to evaluate, as we said. So we've talked there with Lois about identifying the risks and opportunities. The next step then is to evaluate the financial effect of them. And of course, we know this can often be one of the most daunting elements to start with. And here we're going to briefly review some of the key concepts to help with that process. So to help investors understand a company's resilience against climate change, S2 requires a company to disclose information about the impacts of climate risks and opportunities on its strategy and business model. And it also asks that the company considers its financial and operational capacity to adjust or adapt over short, medium, and long-term horizons. For example, you might want to test your company's resilience against a new regulation to limit certain high emissions activities, or to respond to changing crop yields due to more frequent heat waves. So to do this, you'll use scenarios based on climate science and analyse how these scenarios will lead to the effects occurring for the company. And so it's important to remember when we introduce scenario analysis that it's not asking you to predict the future or present a forecast of what is expected to happen. It's really a tool to project and consider potential plausible futures. So just looking at what is possible that could happen reasonably and to test your resilience to that. So S2 doesn't say which scenarios a company should use in the analysis, but it asks the company to use the scenarios and provide information about which it's selected and any assumptions that have been used in the analysis. The standard also includes guidance on how a company can decide and approach scenario analysis. For example, starting with practices that are more qualitative and moving on to more complex and quantitative approaches over time. And overall, the ISSB standards are looking for companies to use an approach that's commensurate with its circumstances and that uses all reasonable and supportable information that's available to them at the reporting date without undue cost or effort. So we'll have a look at another example now to zone in on this a bit and see how it comes out into disclosures. So you probably know the Swiss multinational food and drinks company Nestlé, who we'll be using here in our next example. And what we're seeing here is an output from part of their climate scenario analysis in their 2024 reporting. And here the visual shows the potential impact of physical climate changes on the yield of 12 of their key agricultural commodities, and whether they're expecting that to increase or decrease or stay the same perhaps out to 2040 under a medium emissions scenario. And so overall, this shows that potentially they could see some reductions in yield, and they go on within the narrative of the report to talk about increases in price that could cost for them, and the ability of their supply chain to be resilient to that could be impacted. They then talk in their disclosure as well about how they're taking steps to address this within their business strategy, for example, considering more product innovation, operational efficiencies, and leveraging science, crop science to improve yields and resilience of their crops. So, of course, when we're talking about anticipating the materiality of future events, that can be very challenging. And so to help with this, the IFRS does ask you to look at a number of issues to evaluate the level of uncertainty associated with the determination. So here's a list of some of the factors to consider, which I'll leave you to sort of read through in the handout. But really the list should be considered as identifying the different steps that you should take to come to this judgment on uncertainty. And so any uncertainty that could be identified here relating to future cash flows or the degree of financial effects needs to be evaluated and disclosed. And it's important to remember here as well that this needs to be kind of continually reassessed and reported on. So this may well change over time as new facts and information come to light, and external trends may change as well. Okay, back to you, Lois, for the next one.
Thank you, Fiona. So we're going to look at considerations you might apply when you're thinking about how to integrate sustainability disclosure into your existing set of processes and systems within the company. So the good news here is that you are likely already to have processes for collecting the information that we've been talking about in previous models. So you might already have processes for the disclosure of corporate governance information, the disclosure of risk management processes, and in those cases, you can just adjust those processes to integrate sustainability related information. But in other cases, you might need to develop new processes and plan for the integration of them into the overall systems and processes over time. So here's a list of some considerations you might take into account when deciding whether your existing systems are sufficient to use for sustainability disclosure or whether you need to adjust them or develop something new. First of all, you can conduct a gap analysis to look for gaps in your existing systems and processes. The next two are about whether your systems, including the criteria used within them, are suitable for sustainability disclosure. We know that sustainability risks and opportunities are uncertain. They have different characteristics to other types of risks. So does this mean that you need to add new prioritization criteria to your existing ones for risk management, such as likelihood, impact, vulnerability, or speed of onset? Also, you could take a look at your existing internal controls to see how they could be used to support sustainability disclosure. Then next, and more practically, think about which departments and contributors, both from internal departments and external expertise, could contribute to your sustainability disclosure, and what systems and processes they use. What are the interconnections between different internal and external factors you track through systems and processes, and what do they mean for your sustainability disclosure? How will you deal with uncertainties, and how do processes deal with uncertainties? And what resources are already in place for sustainability disclosure or disclosure more widely, and what resources might be needed? Might you need to go through a change management request process or a budget application process? Now, as you know, we said earlier, the homework encourages you to prepare a disclosure plan. So what is a disclosure plan? Well, it's an one way in which you can integrate sustainability-related risks and opportunities into your organization's overall practices and processes, or it can be a standalone sustainability disclosure strategy. So a disclosure plan helps a company take control of its own narrative. I saw in the module 2 Menti exercise that someone had said, well, it's too complicated. Yes, it can be complicated, but bear in mind that the questions in the requirements ask about your strategy, your company's risks, your company's business model, etc., and how affected by sustainability related risks and opportunities. So the disclosure plan encourages you to look at how these standards apply to your own company. The disclosure plan supports internal collaboration, knowledge sharing, and cross-functional team discussions because it enables you to identify and record who's going to be involved in developing disclosures. Will it be people from risk management, company secretarial, procurement, finance, HR? We saw some of this cross-functional working in some of the examples on governance earlier. How will individuals and their responsibilities be organized and allocated? How will data be sourced? All these types of things can be addressed in a disclosure plan. And once you've decided them, the disclosure plan, most importantly, acts as a reference point, an audit trail for your decisions on these things, for decisions on what are the sign-off procedures, what systems will be involved, who will be involved, what are your goals, and so on. So it's that central reference point. Let's look at an example now from a company called Novo Nordisk, which is a Danish pharmaceutical company. And in their annual report, they set out the basis for preparation of their sustainability statement. And all of the things that they're saying here would be included in a disclosure plan as we understand it. So first of all, the company outlines the regulations, standards and practices that it has to or has chosen to use for its disclosures. So the reader can see that, oh, yes, they're using the Greenhouse Gas Protocol, Science-Based Targets Initiative, and so on. The company also explains the approach and scope used for data collection and verification of its reports, why and how changes have been made to their reporting since the last reporting cycle, how errors have been corrected in the form of restatements, perhaps, the time horizons considered for preparing information. So you can see that in the third paragraph, the company defines what they mean by 1 year, from what they mean by short term, which is 1 year, what they mean by medium term, 1 to 5 years, and long term, more than 5 years. They explain how they've used estimates and where more information could be found about assumptions and uncertainties. So there's lots of contextual information that helps the reader understand how their report has been prepared. Now, as you can appreciate, it's a really good idea to know these things before you start the reporting year. So good idea to do your disclosure plan in advance of the reporting year. Let's look at some Zoom polls now on disclosure plans. First question, you can only answer yes or no here. The question is a disclosure plan required by the IFRS Sustainability Disclosure Standards? You can answer yes, you must disclose your plan, or no, but it's a very helpful tool. See what you think. Yes, in the interests of time, I'm going to end the poll and share the results. Well, most of you have answered yes, but in fact, the answer's no. And that's because there is nothing in the IFRS Sustainability Disclosure Standards that says you must have a disclosure plan and you must disclose details of it. There are some particular requirements that ask you to set out things like the methodology you've used for calculating greenhouse gas emissions. Yes, but there's no overall requirement to have an overall disclosure plan. So the correct answer is in fact no, but we recommend it to you as homework because it is a very helpful exercise, as you've seen, and helps readers, as we saw from the Novo Nordisk example. Let's do one more Zoom poll before we close this module. And the question is, a disclosure plan can help a company to take control of its narrative, support collaboration, act as a reference point and audit trail for disclosure preparation, or skip full disclosure as prescribed by the ISSB. Give you a second to think about that. I can see already that you know the answer to this, so I'm going to share the results. Yes, of course, you're right. It's the first three are correct. Well done for that. It is not an excuse to skip full disclosure as prescribed by the ISSB. You'd still have to make your disclosures even if you had a disclosure plan. So well done for that. We're going to hand over to Fiona for a Module 3 summary.
Great, thanks, Lois. So coming up again to the end of the module, probably getting familiar with the format, but we have a little bit of a wrap up here to remind ourselves of a few key things. So firstly, let's come back to those connections. So in the last module there, we wrapped up by highlighting the importance of connections between the 4 core content areas of disclosure. And then in this module, we've learned that there are many connections as well between a company and its external and internal environment. And really, these connections are what we should be focusing on to identify risks and opportunities. And the second thing we discussed in this module was relating to evaluating the risks and opportunities. And a key component of the evaluation is consistency and transparency in your assumptions. So whilst using climate scenario analysis can be a very helpful tool, it is important to make sure that you're being transparent with assumptions. And if you look to some of the resources that we'll share at the end of the session, they may help you as well in terms of providing pre-packaged scenarios that you could select from, such as those of the IPCC or NGFS, which can be used to carry through some of their assumptions if they seem relevant for you. And finally, as we've seen, even if some of this data isn't your data that you're already disclosing or maybe isn't in use at the moment, it might be that you're already collecting it for other reasons. So it's important to try and make sure you understand what data you already have that you can use for these purposes and to avoid starting from scratch wherever possible. Okay, so back to Menti again for a quick reflection exercise. And here we're thinking around how do we build on those gaps we've identified? And in particular, how do we address some of those challenges relating to data that we've talked about? And so here we just want to ask you to think about how you can go about collecting data and what systems and processes you might already have within your organizations that can support you here. So that is the next question in Menti. So I've reshared the link again with you in the chat there, which is available, but yeah, it's the same link as you've been using before. So let me share the screen to have a look at what responses come through. Okay, I'll just give everyone a moment or two to have a think about that. Someone's mentioned the GHG protocol. Yes, so yeah, exactly. If you're already reporting or collecting any carbon emissions data and reporting your emissions under the GHG protocol, that's definitely going to be incredibly useful information for large parts of the S2 emissions reporting information. So that will definitely give you a good starting point there. Give everyone another moment to have a think. Responses are anonymous, we should say, so feel free to write whatever comes to mind. And yeah, that's just for your purposes, really, to reflect. Someone has said Excel, so yeah, maybe that's a good way to start collecting information for sure. I think there's sometimes a need or feeling that we need some sort of very sophisticated system, but in my experience, many companies, however sophisticated they end up being, often begin within Excel because it just gives that flexibility when you're starting your collection journey. So people have mentioned internal audit and risk management. Yeah, I think those are two very useful things to highlight. So, audit reports may well highlight existing risks that you have, and your risk management processes indeed are probably already assessing relevant risk types for these sustainability topics or topics that have a sustainability aspect to them. So there's likely much you can draw from there. Someone has mentioned supply chain management tools and systems. Indeed. So particularly when you're talking about understanding your wider supply chain and upstream emissions or upstream risks, any assessments or due diligence that you're doing with your suppliers, any reporting that they're required to do for you or pre-qualification questionnaires can be a very useful source of information. We're also seeing sort of benchmarking and looking at competitors, indeed. So getting a sense of what tools they've used, maybe seeing if there's any industry data sources that they reference that would be relevant for you as well, can be very helpful. And then I see a few more responses coming through now around, looking at health and safety data and environmental data, exactly. Often some of this information you might be collecting or reporting operationally, and it's just a sort of a challenge of thinking how you can aggregate up to a company level to understand it. And I see SAP and sensors. Yeah, maybe if you're talking about emissions or energy, actual real-time monitoring might exist for compliance purposes already at site level. Great. Okay. I think that's lots of good thoughts. So thanks for reflecting. I think hopefully the message that we can take from this is that there's a lot out there that will help you with this. And it's really just a case of trying to gather with your colleagues an understanding of what data is there. And what we'd really recommend doing at this stage as well is thinking a bit around the governance that you set up around this data. So we'll talk more about that in the communicate module, but thinking about how you can ensure that you build processes now that allow you to collect data in a consistent and comparable way. Okay, perfect. Thanks, everyone. So that brings us, as we said, to the end of this module and takes us into our final module, which I'll hand back to Robert for. Thanks, Robert.
Yes, great, Fiona. Thank you. Indeed, we'll be moving to their next and final module of this course. We'll be talking about the communication. And the module is then broken down into those three sections: location and timing, efficiency, and confidence. And we'll let us start with the location and where the disclosure should be located to, and we'll clarify that and what the standards are saying about it. But before we go into the specific requirements, I want just to zoom out a little bit and think about sustainability disclosures in the broader context of the reporting package and what is useful for investors. So investors already have access to companies' financial statements, and ISSB standards are designed to identify sustainability risks and opportunities that complement financial statements. So that all come together in a reporting package that we will call a general purpose financial report. So, and the requirements in ISSB standards about what information to report are based on existing sustainability reporting regimes, focus on investor information needs and on aspects of financial accounting standards. Then, on the other hand, GRI standards expand on sustainability metrics relevant to broader societal concerns. And then together, ISSB and GRI reporting standards share some content requirements and, for example, what to report. But the ISSB standards are focused only on investors' information needs and decision-making, reflecting the mission of the IFRS Foundation to bring transparency, accountability, and efficiency to capital markets around the world. So then we need to remember that both organizations take a different approach to defining materiality, but they are not competing. The GRI approach is set out and understood among sustainability practitioners, Whereas the IFRS approach will be then familiar to accountants and relies heavily on management judgment, aligning what is aligning with existing corporate risk management processes within the companies. So, to summarize, together, these frameworks enable companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions, aligning both investor priorities and broader societal expectations. And the way they can interact with each other and actually, there can be flow between the two. We can come up with this example that where double materiality, so from the GRI perspective, the double materiality assessment might identify that some of the company's impacts may also create sustainability risks, which could be so significant that they are important to disclose to investors. So they're not isolated, and they can inform each other. All right, so that was just to explain a little bit on the broader disclosure environment and possibilities there. We'll now go back shortly to material information, what material information is. We already noted materiality has a different definitions for different reporting standards and audiences. And so let's then briefly recap what does it mean. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. So once company has identified those risks and opportunities, it can then determine what kind of information to provide about those risks and opportunities. This is where materiality definition comes into play. So at this stage, the definition of material information used in S1 is based on aligned with definition in accounting standards. Again, this is the information that if omitted, misstated, or obscured by other information could reasonably be expected to influence investor decisions. In other words, the ISSB standards seek to identify disclosure of key information that matters to investors. So the entity determines what constitutes sustainability-related risks and opportunity based on its facts and circumstances. And entities often already have well-established processes for identifying, assessing, and responding to sustainability-related risks and opportunities as a part of their management of their businesses. All right. And now let's talk about disclosing the material information and the requirements around this matter. So investors have asked for disclosures of material information, and the ISSB have been designed to help you gather and disclose it. However, this means that the company does not need to disclose information that is not material, even if the ISSB standards include it as a specific requirement. So there are a couple of things to remember here. For sure, firstly, ensure that the material information is clearly identifiable and that you use plain language. Secondly, it must be also ensured that the information is not scattered across your disclosure. And finally, the inclusion of any additional non-material disclosure is required by regulators, but ensure that it clearly is identified as such. All right, and then to help you understand and to check your understanding of what we just discussed, we have another Zoom poll, and we'll have the question is when the information should be disclosed in the annual report when applying standards, and then there are three options here. When omitting that information could reasonably be expected to influence investor decision. B, it could reasonably be expected to affect the company cash flows. C, it exemplifies the values of the leadership team. Yeah, we discussed what constitutes and what are characteristics of material information and how that material information can be identified. And I can see there's you mostly getting it right. So the correct answers here are A and B. So material information is not about the values of the leadership team. So thank you and congratulations for those who answered it correctly. All right. So I hope it's now clear what material information is. We'll be now moving to the next section of this module, and we'll talk about location and where to report sustainability disclosure. So disclosure under the ISSB standards has to accompany the financial statements and be part of the same general purpose financial reporting package. But as one does not say where in the reporting package the information shall be provided, this is designed to allow jurisdiction-specific requirements on the location of reporting. The most important factor to consider here is to ensure that sustainability disclosures are provided as a part of the same reporting package as the company's financial statements. So sustainability disclosures must be provided at the same time as the related financial statements, cover the same reporting period, and be authorized by the same body or individual authorizing the financial statement. All right, and to further enhance your understanding, we have another example here, and we presented by Lois. Over to you, Lois.
Thanks, Robert. And this is an example again from Ayala, the Philippines-based conglomerate company. And we spoke earlier about using different resources to support your sustainability reporting. And Ayala does an integrated report, and they've used the integrated reporting business model depiction to help organize their reporting and to help organize the way in which they present it effectively to their readers. So you can see that on the left-hand side, the company describes the different types of capital or the different resources that they need as inputs to their business model to create value. And at the end, they describe the value generated. But in terms of organizing a report and how to make it easy to navigate and read, you'll see that in the middle circle where it says creating value, the orange circle, there are references to page numbers for where to find information about the company's outlook, material topics, the stakeholders, their strategy, their risks and opportunities. Also, you can see that there are page numbers against some of the parts of the middle of the circle. They also use icons to help a reader navigate across their report. So you can see on the right-hand side, there's a little skull with a wheel inside, and this is to help readers understand that they're reading about the focused execution of the strategy. So this depiction is a bit like an index for the company's report. It not only describes their value creation model, but also helps a reader to understand how they're going to recognize information using icons and how they're going to find information using page numbers. So we're going back to Robert now to talk about digital reporting.
Yes, that's correct. We'll be now moving to the role of technology in the reporting, and then the technology is an emerging consideration for disclosures. So increasingly, corporate reporting is moving from PDF reports towards the information on web pages with structured data sets, such as those databases which can be found on which are offered by stock exchanges. And the IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and accompanying materials of the ISSB standards So the taxonomy does not include or does not introduce a new requirement. A digital taxonomy provides the common elements or tags needed to make your sustainability disclosure machine readable. So digital taxonomy provides the common element, this makes it easier to take large data sets like information from the entire industry and bring them all together to analyze them. And the digital reporting brings number of benefits. It makes the reported information easier to use for analysis. Data is structured the same across the businesses in a machine readable format. And tagging information potentially allows also for automated checks for quality and consistency. And also more and more collection and management systems are compatible with digital reporting taxonomies. So that improves the processing and reporting preparation. And finally, tags and labels can have a description in different languages. So if you report a data or quantitative data in one language, someone speaking another language will also understand what it means. All right, and then moving to the next section in this module about communication. So following this discussion which we already had on the timing and location, we'll now think about the efficiency of disclosures. We added this to the training because a common comment we find from the company is that there is a growing reporting burden. And we hope that to highlight that there, when done correctly, efficiency can be made to reduce that burden. So first of all, it's talk a bit more in generic terms what it is, effective communication. So it's important to understand that what effective communication looks like and what is required. So often companies think that if they just put all the information they are to everyone and they report all this information, that everyone will be satisfied. However, this would be against the core concept in a particular for presentation. So, for example, there is some number of questions which might be helpful here to ask. So, is the information clear and concise? And by clear, we would then mean, and that would depend on the nature of the information. So, for example, whether it could be clear to present information in tables, graphs, diagrams, and with text. And then concise, the concise would then mean that disclosures need to avoid boilerplate information and unnecessary duplication, and to use the clear language. And then we will then talk about also the quality of information disclosed, and why we are focusing on the quality information, because some preparers watching today might be thinking that they still don't understand what is the fuss about, and then it might be coming from their experience focuses on the standalone sustainability reports, and they maybe did not have much interaction with external audit. And to the accountants watching, I'll be say to be kind to your colleagues, help them understand the difference in rigor that is required in data collection, oversight, sign-off, etc. for financial statements. So bringing the quality, it also means a number of different things. So that, for example, disclosure includes comparative information, and there are to be restated as necessary. It also means that disclosure should avoid unnecessary duplication and cross-references, and use cross-referencing as required. Finally, information has to be material, be connected and aggregated or disaggregated appropriately. All right. And I mentioned cross-referencing. So let's now then talk shortly about what it is and why it might be useful. So as you may have already noticed, there might appear to be some overlap in the disclosure topics. So, for example, you might have the same governance approach for all sustainability issues. So rather than to duplicate certain information, you can use cross-referencing to enhance efficiency of your disclosures. So cross-referencing to other reports is permitted as long as the other report is available on the same terms and at the same time as sustainability disclosures. The cross-reference information is assumed to become the part of the reporting package. And it's important also to note that a cross-referencing shall be applied consistently and transparently, and it should not result in information being more difficult to understand. And then how to do it effectively, and one of the examples we have to showcase this, and Lois again will present it. Over to you.
Thanks, Robert. And this is an example from a company called ArcelorMittal, which is a multinational steel manufacturing company. And as you can see from the title, this shows how they do cross-referencing and help readers navigate their report. So what they're cross-referencing to is the IFRS content elements and concepts that we've been talking about today. So down the left-hand column, we can see that they list the content elements that they cover in their disclosures, and these content elements come from IFRS S1. And then you see in the column entitled Our Response where they cross-refer to so that the reader knows they can find information there. Now, the only thing to note here really is that there are cross-references within the report. So under governance, they'll say, see the governance and risk management section in this sustainability report. In other cases, they're cross-referencing out to other reports, such as the annual report and the 20F. So we can see what supplemental reports they're cross-referring to. Back to you, Robert.
Great. Thank you, Lois. Yeah, and we are now moving to some mechanism that support the adoption. And we are IFRS, we sought to apply a number of mechanisms to support preparers to get started with the ISSB standards. So first, one simple thing to put in place was to adopt well-known terminology and concepts familiar to preparers, borrowing from accounting standards, for example. Secondly, many requirements in S2 and S1 and S2 are to be applied proportionately, recognizing that companies will have a range of capabilities and preparedness on these issues. So, for example, qualitative scenario is permitted, and you will also see the phrase all reasonable and supportable information at the reporting day without undue cost or effort, or commensurate with skills, capabilities, and resources in a number of places. And then there are also a number of reliefs for the first year of application, which have been introduced. And this relief include that companies will be able to limit disclosure to climate only in year 1 and begin reporting on other sustainability-related risks and opportunities in year 2. Secondly, companies will be able to provide annual reporting related financial disclosures with their next half-year reporting rather than at the same time as the financial statements. Another relief concerns greenhouse gas emissions and scope 3 greenhouse gas emissions. So they can apply the greenhouse gas protocol standard to measure emissions if they are already using a different measurement approach, or provide comparative information in the first year of reporting using S1 on S2. Another relief allows companies to include greenhouse gas emissions information obtained from companies in the value chain with a different reporting cycle. And we already mentioned a number of other sources of guidance and resources, including SASB standards, CDSB framework application guidance, among many others. So these reliefs are designed to enable companies to put in place reporting practices and structures to provide high quality decision useful information. Right, and then we'll have now two polls also to reflect on your understanding of the information which we are just covered. So it's again about the information and the characteristics of the information. So information disclosed in accordance with the ISSB standard should be A, decision useful, B, material, C, misleading, D, comparable. And this is should be fairly easy. So please select all that apply. And I see that it's looking indeed good. I'll end the poll here. Yeah, I mean, most of you are correct indeed. The decision should be the information should be decision useful, material, and comparable. It should definitely not be misleading. So A, B, and D, these are the correct answers to this question. And so we'll have another Zoom poll about when the information is decision useful. And again, please do select all the answers which apply here. So whether there's relevant and faithfully represent what it purports to represent, whether it's when it's comparable, C, when it's verifiable, D, timely, and E, understandable, when the information is decision useful. And again, seems like the first answers coming in are indeed correct, and you heard that and you remember that well. Well, for this question, all the answers are correct. So all they represents the features of the useful information. So A, B, C, and D and E are correct. So thank you for those who answered. And we will be now moving to the very last section and the last section of the last module, and we talk about confidence and how to maximize the confidence in reporting. Yeah, and then we're moving to this section and to show how the users of financial reports could gain confidence in the data you're disclosing, as a trust is an essential component of sustainability related disclosures, and increasingly so with the growing concern over greenwashing risk. So the first thing to consider is comparative information. As it is important builder and it's showing data of a trends, showing data and trends over time. So comparative information provides context, helps to indicate progress and underpin strategy risk management. So metrics disclosed by a company might be redefined or replaced over time, or company might change it. Change its methods or estimating a metric. So in this situation, it's important the company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant prior period figures. And also occasionally companies' sustainability disclosures might contain material errors. In these situations, the company is required to restate these errors in the comparatives provided. So the revisions or restatements are necessary only when there is a risk that material information being omitted, misstated, or obscured as a result of not revising or restating the comparatives. And again, information can be qualitative and quantitative. So one more thing to mention here is that companies sometimes express concern with sharing information that they deem to be sensitive, and that if shared could deplete their competitive advantage. And in this context, the ISB standards relieve a company from disclosing information about sustainability-related opportunity if that information is commercially sensitive. If this is a concern you have, there's a further detail you can read in the handout. All right, and then one very almost last thing we need to discuss here is a statement of compliance. Finally, to build confidence was by providing clear statement of compliance. So the company that complies with all requirements in the ISSB standards, even the reliefs, is required to make explicit statement of compliance. And there is a further guidance on this published in September 24 called Voluntarily Applying ISSB Standards, a guide for preparers, which further explains the topic. All right, and so just to wrap up, and this last slide with the list of the things to remember. Please go through the list. You can find the handout in the handout slide deck on additional information in this section with reminders of how to report effectively, and I do highly recommend reviewing that. And having said that, I'm now handing over to Fiona, which she provide a summary of the module 4. Over to you, Fiona.
Thanks very much, Robert. Much appreciated. So yes, this brings us to our final module. So I'll just wrap up quite quickly here. But really in this module, obviously, we discussed where to report information, being clear on your audience and who you're reporting to. So making sure that you have that focus on the primary user as the investor for the IFRS standards and ensuring the information aligns to their needs. We then talked about efficiency and the less is more philosophy of reporting here. So we're not seeking to overload investors with information because actually that could obscure what they need to find and understand. So using the standards can be a good way to try and structure your disclosures to be concise and materially focused. And then finally, we finished off there with report user confidence. So ensuring that your data is accurate, but also presented in a fair and balanced way that builds confidence with report users. And this, we hope as well, is where the disclosure plan, handout and homework exercise that we've shared can support you in building those processes. Okay, so I think in the interest of time, we probably will skip this last Menti activity, but the question was just a reflection point on the different kinds of navigation approaches that you can take to improve reporting. So there's some ideas here that I'll leave you to consider in your own time. We do have a quick final Menti question, which I would be grateful for your response on, though, because I think this is always a nice way for us to round off the session. So I've just moved the Menti along there, if you have it open, to the next question, which is asking you how comfortable you are now with those learning objectives that we started the session on. So those were around, explaining what the ISSB is, using the standards and developing a sustainability reporting strategy. So have a think and let us know how comfortable you feel currently against those areas. And we hope that we've been able to support you in advancing down that journey. So I won't share the screen in the interest of time, but if you can respond to that poll in the background, that's very helpful for us to know. So thank you very much. So just to cover a few final points as we're coming towards the end of our interactive time together. So just as a reminder, and you probably don't need reminding of this, training such as this is really just the beginning of a learning journey. And what's really most important is to take away what you've learned today and start to think about how you can apply it in your own context. So what we wanted to do is just review with you the homework assignment that we've mentioned for the event. So we'll share the link again now, if we can please, Lois, in the chat box. Thanks, Lois. So at the bottom of that page in the resources section, you'll find the homework exercise. And the structure of this homework follows the same structure as the 4 modules of this training around prepare, align, implement, and communicate. and is similar to some of the Menti exercises we started today, but just helps you to build out more detail. So if you work through the structure of that and start to document your thinking aligned to the questions we ask in that homework, we hope that will help you to build that first draft ISSB aligned disclosure plan and really help you to put into action what you've learned from the training. So we encourage you to take a look at that. And we've talked about a lot of different resources today, but just to summarize a few key places to go to find out more. So firstly, we have the IFRS Knowledge Hub, which includes all of the standards and guidance from the ISSB and is being updated all of the time as well to add new resources, case studies, educational material on particular topics, etc. So obviously a great source of information to learn more about the IFRS S1 and S2 standards and everything that accompanies that. We'd also like to share with you this great resource from the IFC called the Beyond the Balance Sheet programme. So you'll see a summary of the contents of this programme on the slide, and there's a QR code and link to allow you to access this in the handout. But really this programme includes lots of knowledge, resources on all sorts of topics pertaining to ESG and wider issues of corporate governance as well. And as a reminder, the SSE is working really closely with the IFRS Foundation and our partners to support exchanges on this topic. So if you missed it at the start, just a quick recap on these guidance resources that the SSE produces in our toolkit as well. This includes the training sessions we're doing today, but also model guidance aligned to the topic and a number of different training tools as well. So a big well done and thank you to all of you who stuck with us throughout this full 3.5 hours of training. We know that this is a long time and that there's a lot to cover, so we're really appreciative for all of you who've asked questions and interacted throughout the session. And as a merit and recognition of your hard work and attention, you're now eligible to receive a certificate for completing the course. So to receive your certificate, you will need to fill out the feedback form, which Lois has just shared the link to in the chat. So if you fill out the feedback form there, you will then be sent your certificate by the team. You'll also receive a link in an email from Zoom about 24 hours after today's session, which shares that link again with you. So once you've completed the feedback survey, please allow up to a week to receive your certificate from us because, yeah, it takes a little bit of time to process all of that. So no need to chase us if you haven't received it within a couple of days. But if after a week or so you are still missing your certificate, please double check your junk folders in case it might have gone there by mistake. And then by all means, you're welcome to contact us to double check that. And so just to close out, we'd like to say thank you finally to the SSE's official supporters who really champion and support this programme. And of course, to the IFRS Sustainability Capacity Building team, and particularly Robert and Bella for joining us today, and the IFC for supporting this programme as well. And of course, a big thank you again to our colleagues at the Lao Stock Exchange, Lao Securities Exchange, and the Lao Chamber of Professional Accountants and Auditors for bringing us all here together today to host the session. And last but no means least, a big thank you, of course, to all of you who've joined us. We've really appreciated your engagement in this session and wish you all of the best with your future sustainability reporting. So have a good rest of the day, everyone, and we'll finish the session there. Thanks very much.